Good morning, good afternoon, and good evening, everyone, and welcome. My name is Colin Mahan, and I'm a program manager at the Nasdaq Entrepreneurial Center. And for those of you who may not know, the Nasdaq Center is a nonprofit that is building a better path for entrepreneurs worldwide by improving inclusion, access, and knowledge in entrepreneurship. As you may have just seen in the chat, the Nasdaq Center, along with our partner Mentor Cloud, launched a free mentor matching platform for entrepreneurs called Mentor Makers. You can create your own advisory board to guide and inspire you with in-the-moment mentorship from topic experts and professionals dedicated to providing exceptional mentorship to entrepreneurs across all races, industries, and geographies. So find or become a mentor today by using the link in the chat. Mentorship matters to all entrepreneurs. Their success is dependent on it. Quick housekeeping, we're going to open up for live Q&A throughout this event, so please submit your questions in the Q&A function at the bottom of your screen throughout the presentation. Now, none of what we do here at the center could be possible without all the amazing support from our sponsors, including Nasdaq, Lehigh University, Bank of the West, KPMG, Wilson Sonsini, Woodruff Sawyer, and BPM. We're humbled and grateful for their contributions. Now, during these still unique times, we're curious on how sentiment is among the entrepreneurs that we work with. So we're going to start by taking a poll to just let us know how you're feeling about your business right now, and also what's keeping you up at night. Both of these help us understand what the community of entrepreneurs and supporters are looking to learn more about and where they need support. So appreciate you participating in this poll. Our next poll is going to lead us into what you're looking to learn about today and with regards to M&A. So I'm just going to give this another moment or so. I'm going to end this poll and share those results. So thank you all for participating. Looks like optimism's on the rise, but totally understand there's a little bit of survival mode out there, tiny bit of anxiety, and a little bit of fear. So hopefully the programs that we offer today and throughout the 2022 calendar year will help you all. Looks like finance is at the top, but good mix on the other topics. So thank you all for sharing that. Our next poll will help jump into what we're talking about today. So what side of the M&A table are you looking to learn more about today? Are you looking to buy side, the sell side, a little bit of both? So let us know and appreciate you all voting. All right. Oh, it's almost a 50-50 split. Okay, I'm gonna end this poll, and there the results are. So it's a pretty good split of buy side and sell side. So I'm gonna stop sharing this, and without any further delay, we're going to kick off by just talking a little bit about our agenda. So we're gonna kick off the program with a market update, followed by an overview of the M&A market. Then we're going to have a quick 10-minute break and transition into our second panel, where experts will share M&A strategy for early to mid-stage entrepreneurs. That panel will be followed by another 10-minute break, and to round us out, our last session will cover growth through acquisitions, the buy-side overview and insights. Please note the same Zoom link will be used for each session, so if you need to drop and come back in, you're more than welcome to. So without any further delay, please join me in giving a warm welcome to our first presenter to share the M&A market update. Suzanne Kumar is Bain Company's M&A and divestiture practices vice president and co-author of the Bain Company most recent 2022 Global M&A report. Suzanne, welcome. Oh, you're muted.
Yep. Hi,
awesome.
Thanks so much for having me today.
So looking forward to this, and over to you.
All right. Let me get my screen up here. All right, so thank you again for the introduction, Colin. Again, my name is Suzanne Kumar, and I'm the practice vice president for M&A divestitures at Bain Company. I'm based in New York City. In this role, I lead our M&A Insights team, including our recently published Global M&A report for 2022. And I'm pleased to be here today to share Bain's perspective on the strategic M&A market. So as you may know, Bain is a global management consultancy that helps change makers from every economic sector in every region of the world. We're the industry leader in M&A support for corporate and financial sponsors with deep expertise across the M&A value chain from strategy to due diligence to integration or divestiture. And we write our M&A annual report each year to help practitioners get better at the art of M&A. We examine the market trends, identify key issues for strategic deal makers, and share insights across sectors. I think we'll share the link to the report in the chat for those who want to learn more. So, what do we have to learn from the 2021 M&A market? The 2021 M&A market was white hot. Strategic M&A grew 47% to $3.8 trillion. This was the second highest deal value ever for strategic M&A. And when we say strategic M&A, we're talking about classic M&A, corporate and PE portfolio companies that are doing add-on deals. And these companies are paying more than ever for attractive targets. Strategic valuations hit a record high of 15.4 times in 2021. And with assets priced to perfection, strategic deal makers needed to expand their M&A toolkit to be successful. If we take a step back to look at the whole M&A market, it hit $5.8 trillion in 2021. This is an all-time record for M&A. No other year comes close. Now, beneath the headlines, there's a few notable trends. Non-strategic M&A grew twice as fast as strategic M&A, a collective 100% year on year. We see that financial investors, which includes private equity, had tremendous growth, 77% year on year. But they were outpaced by venture capital and SPACs. The popularity of SPACs in the first half of the year led to some eye-popping growth. But I think it's fair to say that this deal type is more of a fad that has had its day. We don't anticipate this to continue at such a strong level going forward. Why was 21 up so much? A couple of big reasons. There was significant liquidity and access to low-cost capital across all these deal makers, whether you were strategic, PE, VC, or SPAC. And strategic buyers continue to face a real need for growth and transformation that comes through M&A. And finally, we think that there's some of this that was deferred deal making from the pandemic lows in the year before. The big headline was that strategic multiples hit all-time highs of 15.4. This was the talk of the year in M&A, especially for those of us who remember discussing whether multiples would ever get to or stay above double digits. It's worth noting, though, that the public market valuations grew even faster. And around 2017, we saw this decoupling of strategic multiples versus the market, which created some arbitrage opportunity in 2021. And we step back and look at the multiples by industry. Tech at 25 and healthcare at 20 really stand out above the rest. These two industries are rewarded in the stock market for revenue growth. So it should be no surprise that they pay up for growth with the right acquisition. But the red bar representing 2021 is up across sectors. This is putting a lot of pressure on buyers. Some are going to have to back off from deals because they can't make the math work. Or you can see that revenue synergies have become more important in deal making. And valuation is something that we at Bain are keeping an eye on going forward. Now, let's take a look at strategic deal activity through a few different lenses. First, let's look by industry. Deal activity was up across sectors, led by industrials, financial services, and media, which saw the fastest growth. We look at the biggest chunk of the market, diversified industrials. This hit an all-time high of $538 billion. Industrial companies did a lot of managing and proactive managing of their portfolios. A lot of scale deals in here alongside with a high rate of divestitures. In the tech market, deals less than $500 million in value accounted for 96% of all technology M&A. Half of the deals were less than $100 million. So a lot of these are going to be smaller capability deals or acqui-hires. The pace of this means that some big tech acquirers are doing 30 deals a year or a deal every other week. These hyper acquirers are defining a new standard for building an M&A pipeline, integrating capabilities, streamlining the approach, and getting to value creation. And then the last one I'll note is ENR, or Energy and Natural Resources. In 2021, 1 in 5 deals greater than $1 billion focused on the energy transition. So this is an example of how ESG, environmental, social governance factors, are starting to permeate M&A. In terms of deal size, it was really deals in the mid-range of $1 billion to $10 billion that drove the growth in 2021. We saw a little slower growth in mega deals, a little less than 15%. And we look at also at where are these deals coming from? Are they full company sales or divestitures? Last year, divestitures and spin-up returned as a major type of transaction, 60%. This probably reflects 2 big trends. Post-pandemic, we see a lot of companies transforming their portfolio, really taking a strategic lens and reevaluating which businesses they want to keep and which ones they want to reinvest in. You can see that in the divestiture numbers. And then second, the decision to divest is always made easier when you can get a high valuation multiple at exit. And ultimately, good deal making reflects a company's strategy. We observe 3 main types of deals: scale or consolidation deals to improve cost position and drive near-term earnings growth. Some of the examples in last year include Discovery Warner Media blockbuster deal, nearly $100 billion, to accelerate both Disney and Warner's plans for streaming services, or Woodside Petroleum BHP, who tied up in a $14 billion deal of oil to create a combined oil and gas portfolio in a top 10 independent energy company. Growth-oriented deals we classify as scope. Typically, these are used to enter or expand into faster growing segments of the market. In 2021, a few examples include Square and Afterpay, where Square used Afterpay to get into the buy now, pay later market, which was really hot for M&A last year. And Amazon MGM, for $8 billion, you can see Amazon building out its content library with the acquisition of MGM and its studios. A subset of scope deals that's quite interesting are capability deals. Here, a company's acquiring a product or a service innovation, typically digital, to strengthen a competitive advantage. An example that I've included here includes Hitachi and Global Logic, a $10 billion deal where Hitachi actually acquired Global Logic's engineering and digital services businesses to bring right back into Hitachi's core businesses. Or Qualcomm Veoneer, where Qualcomm made a big move into the auto space and gained access to product design capabilities for autonomous vehicle functionality and connectivity with the acquisition of Veoneer. Now, at Bain, we've been tracking the mix of scale and scope deals for a number of years. So let me share what that looks like over time. Going back to 2015, scale deals outnumbered scope deals 2 to 1. But then, as pressure to find growth and to transform digitally, that we saw more and more scope deal activity across sectors. Until pre-pandemic, scope deals were actually more common than scale deals. Last year, that trend reversed. We think this reflects both a focus on efficiency and operations, as well as some opportunistic deal making, as the disruptive markets created some opportunities for buying and competition. One last data cut for 2021. In venture capital, I think it's worth noting that there's a really rising prominence of corporate venture capital here. It's growing faster, even faster than overall VC, and it now makes up $1 in 5 of VC investment value. And then finally, let me put this through. While we enjoy looking at the nuances of M&A market from year to year, there are some fundamental truths about M&A that withstand the test of time and the ups and downs of the market. So what we do is we assess the returns to shareholders of the different M&A strategies employed by a universe of nearly 3,000 publicly traded companies from around the world. And it turns out that 2 axes define what differentiates M&A performance: frequency, how many deals you do, and materiality, how much of it you do across the bottom. It doesn't take a lot of deals to become a frequent acquirer, about 1 per year. To be a material acquirer, does require heft, namely 70% or more of your market cap from acquired companies over a decade. Still, 18% of the companies in our sample were considered material acquirers. So what does this tell us? First, consistent M&A activity over economic cycles contributes to higher TSR. This finding holds up year after year across industries. Deal success and deal failure is more a matter of cumulative experience and capability in making a deal and less a function of standalone deal circumstances. And second, similar to most things in life, you get better at what you do when you do it repeatedly. Doing more deals earns more than 200 basis points in TSR. It puts you in the top half of this chart, with another 100 for material cumulative deal value. Meanwhile, infrequent acquirers and those who acquire selectively miss out on more than 250 basis points of TSR. So let's turn back now to the forces shaping 2021 and what that means for 2022. The regulatory environment is one that continues to evolve. Regulatory scrutiny, particularly antitrust, is creating some uncertainty for buyers. Previously, antitrust has focused on a combination's impact on pricing power, but you can see now that regulators are expanding the definition of anti-competitive behavior. The growing concerns around the nature of power in tech is changing those dynamics. The traditional focus on price overlooks free services that are often offered in exchange for consumer data and the power of that collected data. And meanwhile, with network effects of scale, some tech companies are able to lower prices while still quashing competitors, if you think about Amazon, for example. So the scrutiny is evolving in a market by market fashion and varying across regions. In the EU, they instituted some rule changes in 2021 to increase regulator power in cross-border deals and deals below a reporting threshold. The US, we see with the change of administration, an executive order for the FTC and the DOJ to revisit merger roles. And then interestingly, in the UK, they had some early mover action with Meta's acquisition of Giphy. This drew attention because they made a ruling after the deal was completed on the basis of competition, despite the fact that at the time of the acquisition, they actually didn't have revenue in the UK. So people are paying attention. Is this a sign of more to come or a one-off with a focus on Meta? Separately, vertical integration is getting more scrutiny. We saw just last week 2 deals that were called off on NVIDIA ARM and Lockheed Aerojet. Both of these deals attracted concerns that they would dampen innovation and competition. And what does it mean for deal makers? In our recent survey of executives, they told us they're building in more time to get a deal done. There also are going to be some deals that may be accelerated to avoid anticipated rules changes. At the same time, we would expect to see some chilling of deal pipelines as the new regulatory regime comes into focus. So what's our overall outlook? On the whole, we're optimistic that the M&A market will continue to be strong, but we recognize there's some shifting grounds. On the positive side, strategic buyers tell us they expect to do deals. In our recent survey of executives, 9 out of 10 strategic buyers expected deal activity in 2022 to stay the same or increase. And this is because business strategy is the biggest driver of M&A. In that same survey, 8 out of 10 execs said that M&A is a core part of their business strategy, whether they're using it for scale deals to strengthen competitive positions or scope deals to continue to grow and adapt in a transformation. And then also, strategic M&A has had more moderate ups and downs than overall M&A, which does limit the risk of a major correction this year. That said, there's a lot of risks. There's tightening fiscal policy, and I'll speak in a minute about interest rates, supply chain and inflation that impacts corporate finances, uncertainty around regulatory evolution, which I just covered. And then, of course, there's geopolitical dynamics, which may impact cross-border activity, and the continued presence of sponsors, which significant dry powder, really some ongoing competition for strategic buyers. If I take a moment now just to talk about interest rates. Again, I think it's important to emphasize that fundamentally deals are motivated by strategic importance. But that said, a higher interest rate environment increases the cost of capital, which reduces the long-term value of assets. This puts pressure on valuations. So while we're generally optimistic on strategic M&A market, we have to recognize that a rising interest rate environment could put a dent in some of the headline grabbing numbers that we saw in 2021. In the near term, uncertainty may accelerate some deal making, pull it forward. We could also see a pause as buyers and sellers realign on price with a reevaluation of asset values. And if and when corporates begin to factor in permanent increase in the cost of capital, it could take a long time to return to the current market highs. Even then, there's going to be interesting M&A opportunities for really well-positioned buyers. Reflecting on the trends and unique challenges of today's market, I want to call out 5 main implications for deal makers. The first is talent. Talent is a critical driver for deal success, and it's never been harder to get right. Execs tell us that talent retention is the second highest factor for deal success, behind only a clear deal thesis. And when more people than ever are considering or making a job change, the risk of attrition in a merger or acquisition is particularly acute. The answer is not just more financial incentives. Execs need to expand their people diligence, creatively read the talent landscape, and design integrations with retention in mind. Our research says that a compelling vision for the future and clarity on roles are the top 2 most important drivers for talent retention. In terms of revenue synergies, high multiples have moved revenue synergies from nice to have to table stakes. Traditionally in M&A, revenue synergies have been treated more as an art than a science and a longer term priority at best. However, the number 1 most cited reason for deal failure is overestimating revenue synergies, or perhaps better said, failing to capture those synergies they estimated. However, I'll tell you, we are seeing with some of our most sophisticated clients that by addressing revenue synergies and go-to-market issues really early on can massively accelerate value creation. So in short, the approach needs to be much more rigorous, more proactive, customer-centered, data-driven. ESG is a hot topic in most realms today, but frankly, it wasn't much of an M&A imperative in 2021. What we do see, though, is a real opportunity to address it going forward. What does ESG even mean for M&A? Some deals are going to be ESG motivated. For example, one that helps an energy company transition to renewable sources of power, or a consumer products company shift from animal to plant-based foods. But for many, M&A is going to be M&A ESG conscious, considering ESG angles even if they aren't central to the deal thesis. For example, we were working with an industrial client whose end market customers are demanding more environmentally friendly products. So in the diligence, a big question was how much more of the target's efficient products would actually appeal to end customers that value sustainability. Our client did the deal because it was ultimately good for the environment, good for customers, and good for the company. So in short, what executives need to do is avoid making ESG yet another diligence checklist item and really think about using this new lens to uncover sources of value in their M&A. The last 2 are alternative deals. These are more relevant than ever as high valuations are prompting strategics to pursue JVs, partnerships, and corporate venture capital. These can be attractive, but they do require distinct approaches. JVs and partnerships are really a core part of corporate M&A. Nearly all companies we speak to have had done at least one strategic alliance or partnership in recent years, and they work. Most partnerships deliver value. We see companies using partnerships to share risk and capabilities amidst disruption. So for example, automakers are partnering to address challenges of electric and autonomous vehicles, or we see alliances to reduce plastic waste in consumer products. And then CVC, we highlighted earlier, has really grown dramatically in the past years, now comprising almost 1/5 of venture capital. This can be a bit of a trap for corporates who are more comfortable with the traditional M&A playbook, but they can use corporate venture capital is a market sensing mechanism. I mean, a VC fund gets as much value from the insights that it gets from the 98 ideas that it doesn't invest in as the 1 or 2 it does. And the same can hold true for a corporate that really sets up their CVC fund as an independent entity and treats it as such. So in conclusion, I just want to say thank you for the opportunity today to share these observations on the M&A market. Again, to learn more on these topics, including deep dives on industry and geographic markets, please check out the full report on Bain.com. And I'm happy to take a few questions if time permits.
We have maybe a minute for a quick question, but we got one that came in. So thank you, Suzanne, first and foremost, for that awesome overview, the really interesting data there. Question from the audience. Why do you think SPACs, or do you think SPACs are a fad, and have they had their time and are not a sustainable model?
Well, SPACs have been around for a long time. I think it is more that that structure was discovered and got a lot of capital as an alternative to the IPO market. I don't necessarily think that it's an addition to, but maybe a substitute for those kind of exits. I think what's interesting when people look at SPACs is the performance there looks a lot like what we did with our frequent acquirer analysis. The companies that come into and use a SPAC structure in a business that they know and understand are being successful. I think the trap that some are falling into is it's an easy way to do an acquisition, and that doesn't necessarily lead to results or positive ones. So we see it pulling back as people are getting a little savvier about how to use it.
Awesome. Well, that's all the time we have for this, but I really appreciate you sharing your insights.
Thank you.
We've shared the link to the report, so check that out. So thank you, Suzanne. And up next, we've got our expert panelists covering what the effects the current economy has on mergers and acquisitions landscape. So please join me in welcoming our moderator, Roberta Burrows. She's a board member at the Nasdaq Entrepreneurial Center. We've got JP Diddy. He's the managing director at KPMG Corporate Finance. We've got Kathy Koo, corporate partner at Wilson Sonsini, and Emily Meyer, partner, national group leader, M&A insurance at Woodruff Sawyer. Team, welcome. So happy to have you.
Thank you, Colin. Thank you so much.
Thanks, Colin.
Welcome, everybody. My name is Roberta Burrows. As Colin mentioned, I am a board member of the Nasdaq Entrepreneurial Center. I'm really happy to have you today for this wonderful panel that I know that we're all going to get so much new and great information out in terms of the overview of the M&A market. As a board member of the Nasdaq Entrepreneurial Center, I have been a part of the center since its inception. I am also, too, a center advisory board member and the co-chair of the nominating and governance committee for the Center Advisory Board. Without further ado, though, I definitely would love for our illustrious panel to introduce themselves. JP, could you start?
Sure. Hi, my name is JP Diddy. I'm a managing director at KPMG. I lead the corporate finance practice for software. I've been an investment banker for the last 21 years, and prior to that, I was a corporate tax attorney.
Thank you, JP. Kathy.
Good morning, everyone. Thanks for having us here. Catherine Koo. I'm a corporate and securities and M&A partner at Wilson Sonsini and head of our Los Angeles office.
Thank you, Kathy. Emily.
Hi, I'm Emily Mayer. I'm a partner at Woodruff Sawyer and I run the transactional insurance group.
Thank you, Emily. So let's just jump on in, everyone. I think this is a question I'd like to address to all of the panel. So if you could all go around and provide some good insight on this. We really want to know, how did this year start off with M&A for you? And more specifically, how did M&A look from kind of like a pre-Omicron perspective to post-Omicron where we're getting right now? And can you also too specifically talk about how inflation maybe has marred some of the M&A activity? Emily, could you start?
Sure. I mean, I think I'm not sure we're in a post-Omicron world yet. And I'm not sure we're in a post-COVID world. I think we're moving in that direction. I think its impact obviously is less, and I expect it to be less in terms of how we do business this year. But I think it's still going to be there in terms of M&A, in terms of, you know, digital healthcare is still going to be what everybody's very interested in. And you know, companies that have incredibly strong margins and the ability to scale without sort of physical premises that are going to be more attractive. And I still think some of the, you know, retail, brick and mortar, and restaurants, etc., and hotels are going to be less attractive. So I think, you know, from that perspective, it will continue. I don't know that it will. I don't think it's going to change the way we do business. You know, high inflation, personally, I don't think is a blip. I think it's going to be around for a bit. And so the question is how interest rates are going to respond and what that's going to do to valuations and what's that going to do to the cost of lending, and what impact that's going to have on M&A activity as a whole. And I think I would be very impressive if by mid-February, I could tell you what that was going to look like for the rest of the year.
Kathy, did you want to weigh in on that?
You know, I would say I largely agree with Emily in terms of not feeling that we're in a post-Omicron world or likely to be there soon. I think what I would say is we see some continuity from the disruptions that were created by the pandemic. So in particular, focusing on tech companies or tech adjacent, I think there continues to be a real crunch in talent. And so I think Suzanne earlier said, you know, talent is a really key part of any acquisition. I think retaining talent is getting harder and harder because of the Great Resignation and because there's generally a heating up overall in the labor market, particularly for those individuals who can really add value to growth companies. I think also supply crunch in material goods, hard goods, for those companies for whom it's relevant, that will continue to be and already has been a real damper on the business. And I think that's going to have consequences for what we see in M&A and their ability to get the pricing that they hoped for.
JP, would love to hear your input on this as we
sure. I agree. I agree with the comments around, you know, from a society perspective, not quite being past Omicron yet. I think we would all agree with that. However, I would say from an M&A perspective, I think that's kind of in the rearview mirror only because, you know, 2000, even though we kind of lost Q2 to COVID, and certainly 2001 were all-time records for mergers and acquisition, both on a deal size as well as a number of transactions. So I think, at least from an M&A service provider, both the buyers and sellers are still in the market, irrespective of COVID or Omicron or anything else. So, and that's really driven by the, you know, low interest rates and high cash balances on balance sheets. So I think M&A will continue. I think inflation is, as I think Kathy just alluded to, or maybe it was Emily, it's not really having a major effect on M&A yet. We're still at historical all-time lows for interest rates. I mean, there are interest rates at negative interest rates and zero and a couple percentage points. Certainly from a borrowing perspective, from a buyer perspective, you know, they're not getting cash for deals at 0% interest, but they're still at all-time lows. So I think any upticks over the next year or two will have some muted effect, but I don't think it'll have a major effect because interest rates at the end of the day, they help M&A, but they're certainly not going to be a major impediment. No one's going to say, I'm not going to do that deal because my, you know, percentage is half a point higher.
Thank you, JP. I'm going to actually start now addressing specific questions to each of the panelists. Kathy, I know you represent a lot of companies on the sell side. So from your perspective, what have deals looked like now? You know, maybe has there been a change from the end of the year up until now? Are they looking similar? Could you speak a little bit about that?
Sure. So it's an interesting question. I would say there's a lot of reassessment. Um, I was reflecting during Suzanne's overview of the market on how we measure activity. We usually measure activity in the M&A market in terms of dollar value of deals completed. Um, when I look at the end of last year coming into this year, in terms of the number of clients, buyers, and sellers looking for matches in the market to do deals, I think the activity is extremely high. I think there has been, since the end of last year, coming into this year, what I would call a realignment. I think there's, the market volatility is causing people to reassess the valuations at which they're willing to do deals from the buy side. And I think from the sell side, the clients are trying to understand, are we prepared to do the deal at that reassessed value? So to me, I've been seeing a lot of impact of what would have been a sale of control be restructured as, corporate venture capital, instead being reconsidered as an alliance or joint venture, all of which is within the realm of M&A, but I've been seeing less of the true classic sales of control being completed. So high activity, but I think there's been a change in the nature of the activity. And, just looking forward, it feels to me as though we're going to continue to be very busy, those of us who are service providers in M&A, because again, people are going to be reassessing value and opportunities. And I think it's going to be interesting to see how much actual, matchmaking there is that's successful in the form of completed deals.
And in terms of that too, particularly speaking of the high activity, kind of moving towards you, JP, in terms of what are deals looking like in terms of the speed of deals since the pandemic? Obviously, Kathy talked about the uptick, but can you speak upon the speed of deals since the pandemic and where we are now?
Sure. So I think the speed of deals is pretty interesting, right? I think deals have always generally been accelerating, particularly from the service provider perspective, whether it's counsel or financial due diligence or M&A advisors. We all get better at our processes, right? And so I think the general speed of deals over the last 20 years that I've been doing it have definitely increased. Now, Q2 of 2020, I believe everything came to a screeching halt as we tried to figure out, how deals were going to move forward under COVID. And at first, if deals were going to move forward at all. But then once we kind of limped through that Q2 and into Q3, I think buyers and sellers, because they had to, started to get comfortable with much fewer face-to-face meetings, if any, and more Zoom calls or webinars or Teams meetings or whatever it was. And I've actually had, during that time, Q2, Q3 of 2020, we'd still go through our management presentations with potential buyers, and we would actually get LOIs and choose a partner before the teams had even met. And then as part of the due diligence process, the buying team would, even if they had to, they'd get on a private jet from, to protect from COVID, to go down and meet with the team, because it's hard to deploy $100 million, whether you're a strategic or a private equity firm, if you haven't even met the team, right? So that was happening. And then since that time, I've had several private equity firms actually tell me that, rather than going it down and meeting a team for 4 hours for a management presentation and then having dinner, they're actually getting more value out of these Zoom team meetings where they can, maybe it's a shorter duration, but it's higher volume, right? So over a diligence period or a, management presentation period, they may have 5 or 6 individual meetings that are an hour, hour and a half each. One may be focused on finance, one may be focused on go-to-market. So whatever the topics may be, but they're actually getting more interactions with the management team, and it's less staged, if you will. So, and then I think that's helping now with the speed of deals from the perspective of it's not just, one face-to-face meeting, but several interactions. And then I think rep and warranty insurance is helping as we get into, the deal terms around the LOI. It's certainly helping move on the diligence front. So again, I think we are now back up to speed and continuing to increase our speed of deals.
Thank you. And you actually queued up my next question to Emily very well in terms of just, Emily, any advice from an insurance perspective for both startups and corporates as they look to conduct M&A?
That's a very big question. The market and rep and warranty insurance obviously went through an unprecedented hardening at the end of last year, which was very much around supply and demand. And was also, and we've spoken to it as well, the search for talent, right? It takes a long time to become a talented underwriter or broker in this area. It's not very traditional insurance. And so having enough people to cope with the just tremendous requirement for rep and warranty insurance, coupled with the crush of deals towards the end of the year, actually meant that underwriters were in a position where they were turning down work for the first time. And so it became very interesting to see that happen. What I would say is going into the new year, we've already seen a shift. In January, I started to see it. We were looking at pricing that was, the beginning of last year, we were at sort of 3 to 4%. By the fourth quarter, I was not as a general rule, but I was looking at some deals where we were looking at 9%. Now we're back to February, and I saw my first less than 4% quote yesterday. Yes. So the crush has gone. There's, the beautiful thing about rep and warranty is it's non-renewable business. So beginning of the year, everybody's book goes back to zero, and everybody has a new budget that they have to fulfill. So what I would say is it's going to be very interesting to see how rep and warranty insurance, which I think has become table stakes, it's proven itself as valuable. It was very interesting for me to see it get squeezed for the first time in a deal-making scenario and become less amenable than it had before, and not all deals could get coverage, and to see what kind of impact that would have. But what I'm seeing is, as we're coming into the new year and the flows going down, that we're returning back to sort of normal behavior. I'm still seeing a very wide spread, which is interesting to me, which means that underwriters are not sure where they should be quoting, and in fact, anecdotally have said much the same thing to us. Sort of, we got these crazy prices at the end of last year, so we're not really sure what we should be quoting. So instead of having sort of 5 or 6 quotes that are roughly all the same price, I'm getting really wide ranges, which tells me that nobody is sure quite where they should be pricing things, which is very interesting. And it means there's more room to negotiate and push back on pricing. So I would say, when you're thinking about it, and I'm assuming that you're thinking about rep and warranty insurance when you ask me that question, because to tackle the whole of insurance would be a bit much, sort of, we went through a hard period, we seem to be returning to sanity, and I think it will continue to be sort of, we'll get back to the sort of 3 to 4% by mid-year as a general rule. And I think people are staffing up and developing teams and building more capacity, and we have new markets coming in already to take advantage of that. So I think it will settle back to the way it is and continue to be the tool. And the slightly nerve-wracking last quarter it's gone now. It's gone
now. Well, Kathy, actually, I just want to go back to JP just because you were talking about that insurance and the due diligence parts. Are you seeing some of the same things that Emily's talking about, just in terms of your deals right now, some of those changes? And then Kathy,
100%.
You.
Yeah, 100%. I agree with Emily fully that the rep and warranty insurance has become table stakes, right? So if you think about it from a sell side perspective, if you're selling, I'm just going to use a round now, if you're selling your company for $100 million, historically, you'd have to have an escrow for your rep and warranty around 10 to 15%. So that's $10 to $15 million of holdback on the purchase price that would go into escrow, that would be released over time based on, whatever claims that the buyer may have against it. Now that we have rep and warranty insurance, that 10 to 15 million, not quite all of it, but is going to the seller at the time of close, which is a fantastic outcome for the seller. And there's insurance on the back end to protect on that rep and warranty. And another thing that we're seeing in the rep and warranty insurance that we actually promote a lot is that the buyer and seller split that cost, right? So you're really getting the right amount of insurance at the right price. Otherwise, you're going to have this discrepancy of somebody wants complete coverage over everything that could ever happen in the universe from a MAC perspective, and someone who doesn't want to pay that much. So by having them split the cost, both sides are incentivized to get the right amount of insurance for the size and complexity of the deal at the right price.
And speaking of that too, in terms of the buyer and the seller splitting the cost, obviously this is a different type of term. So overall, just Kathy, in terms of the M&A deal, the terms that you're seeing right now, have they changed? What's kind of the forecast that you're seeing as we're kind of going towards this endemic period versus where we were?
It's an interesting question. I have not actually seen a fundamental shift. I think, JP, I think, his observation is a good one, which is that even when we see initial negotiations where sellers and buyers are trying to push on each other 100% of the cost of securing the insurance, I'm most often seeing the parties agree at the end of the day that it's better if it's a mutual process and that both parties will have skin in the game that's healthy for everyone if it's split 50-50. So I've seen more discussions about whether it should go 50-50, but in terms of actual outcomes, I've seen the terms largely stay where we've traditionally seen the market, which is to split.
That's good. That's definitely something that is good for us to know in this time, because I know a lot of people are just thinking that everything has changed with the pandemic. So hearing that something has been stable is actually a little interesting.
There are some eternal verities, there are some, very few of them.
Going on to another topic, JP, specifically, are you seeing more or less international M&A transactions than last year, even since the pandemic?
Listen, I think, I don't know if it's pandemic related or not pandemic related, but I think international deals are continuing to increase. KPMG, we're an international firm. I think we're in 78 offices in 78 plus countries. And, so we do a lot of cross-border deals. This morning I was on with our Swiss team looking at a potential opportunity. I'm working on a deal right now with our Australia team. I'm working on a deal with our UK team. So I think from an international perspective, M&A continues to be very robust. I mean, there's obviously macroeconomic issues. I mean, I don't think we're going to see a lot of deals between the US and Russia or the US and China. But other than that, I think there's a lot of global M&A, and just, cash is cash and deals are deals. So at the end of the day, interest rates are low generally around the globe. Everyone's looking for growth, whether you're an international private equity firm or a national private equity firm, you're looking for new opportunities because it's a very competitive market. Firms like, private equity firms like, Advent's global, HG Capital's global, smaller private equity firms like Excel KKR now have offices in Australia and Europe. And I mean, it's a global economy, not only for trade, but for M&A.
Do you feel like that increased more with the pandemic just because people were able to do a lot of deals via Zoom, do those meetings that you were talking about? Do you feel like that has kind of exacerbated people's open-mindedness towards more international transactions, or do you feel like it's the same and it's just kind of growing at a clip that it normally would have, even if we didn't have the pandemic?
Well, I think the move towards Zoom and Teams or whatever has certainly helped, just because it brings the world closer together. Not that I'm selling Teams or Zoom or anything else, but it certainly has brought
Disclaimer,
our-
disclaimer.
Yeah, disclaimer. It certainly has brought our international teams together, right? I certainly have more face-to-face meetings with UK and Australia and Switzerland and Canada and Germany and everyone else. So it certainly has, I think it certainly has helped. I don't think it's a driver, but it certainly helps in the overall process. And people just become accustomed to it, right? So I think they still have to, as I talked about earlier, still have, boots on the ground eventually to meet teams and check some boxes. But during the deal process, it has certainly helped accelerate and brought down global walls.
Kathy, I think you were going to also chime in there.
Oh, sorry. Yeah, that's the danger of having all of us off mute. I was just sort of nodding along with JP and agree. No, I agree. I agree with him. So I don't think the pandemic, I don't think Zoom and MS Teams are the drivers, but I do think, for the audience, whether they're buy side or they're sell side, I mean, it's an interesting question. Let's think back not 2 years before pandemic, right? But think back 5 or 6 years. I think by comparison of 5 or 6 years ago, startup and growth companies are going through or doing M&A sooner in their life curve, than they did 5 or 6 years ago. I think they're doing it more globally than they did 5 or 6 years ago. And I think those broader changes are unlikely to roll back because they're not pandemic driven. To JP's point, I think the literal working out and doing of a deal may have changed because of the pandemic and, the way that that's impacted us socially. But I think there's a broader trend, a longer term trend in the M&A for growth companies and around growth companies that isn't going to reverse once the pandemic is passed.
Emily, I just want to go, I feel like this is a really good topic just in terms of what we've been talking about, M&A, overall market, and with the pandemic. So would love to hear your 2 cents too.
In terms of global activity?
Yeah. Mm-hmm.
Yeah, I mean, I have to agree. I don't think the pandemic has driven it. I do think that people have got much more comfortable with not being physically face-to-face, and that obviously that allows you to sort of travel greater distances, if you will. But I also think that globalization as a concept has been growing for some time, right? The world has been getting smaller and cultures have been intermingling for decades and decades and decades. And I think that the opportunities are worldwide, and as all countries get to a developed level, there are opportunities everywhere. So the world of opportunities has expanded, which means the ability to do business in different countries has expanded, which means the willingness to do business in different countries has expanded. And we are certainly seeing more cross-border activity than we have previously. It's still mostly America going out and purchasing, but we're also seeing an increase of other countries coming into the States and wanting to use rep and warranty insurance on American style coverage for their European purchased deals, which is where it sort of helps smooth the difference in different legal systems.
And just pivoting a little bit, Emily, from your insurance lens too, how are you seeing providers now measuring risk, and what's your advice to help them mitigate any risk?
Sure. So insurance is interesting in how it interacts, right? There's 2 ways to make money in insurance. You get very, very clever about how you underwrite risk, and you make sure that you don't make any mistakes and that none of your clients have losses, or you get as much premium as you can and you get as much investment income on that premium as you can. So as we're going into a period where and I agree, interest rates are very low right now. As we're going into a period where interest rates historically have been very low, we've seen underwriters get very tight on underwriting, right? Because that's where they're going to make the money, having a low claim report. And that's true across all lines. When we see interest rates rise and the value of bonds, et cetera, go up, where a lot of that premium money sits, underwriters, and it'll take a while to feed in, but underwriters become less interested in having very tight underwriting perspectives and more interested in getting premium in the door, which means that rates tends to go down and coverage tends to get broader. So I would say from an M&A perspective, I would be concerned about D&O, I would be concerned about cyber, and I would be concerned about, as always, the big issues that underwriters in my world are looking at are financials. It's getting increasingly difficult to get cyber coverage for startups or, in fact, for anybody with any kind of legitimate cyber exposure. And I don't think that's going to change. That market is so hard, and I don't see an end in sight for that, even with the potential to make more money in premium elsewhere, just because nobody really understands how to quantify that risk right now. And it seems almost impossible to defend against. So that has become a massive focus, and it's become a massive discussion at board level, and it's become a massive issue of pricing. We're seeing, our clients going bare for the first time because they literally just can't handle the premium uplift. And so I think, and D&O has gone through a hard market, and with the there's been a drop in securities class actions, but we're yet to see how the SPAC class action suits are going to land and how that's going to impact D&O insurance, et cetera, et cetera. So really unhelpful answer. We're in a period of flux. And I would say if I was setting up a startup or I was looking at selling my company, I would be focused, or I was looking at buying a company, I would be incredibly focused on the target cyber coverage, how long they've had it, how good it is, and their claims history. I would not be even thinking of buying a unaudited company without doing a Q of E, because you're just not going to get coverage for that. And I would be looking very deeply into their existing insurances, because everything I buy from Rep and Warranty is going to sit above that. So I need to know that that's of high quality. And because of things like cyber and D&O and those tail policies, underwriters are sometimes increasingly looking to exclude those entirely. So you have to find an alternative way of getting coverage for those specific risk areas. And that's becoming harder and harder to do, especially when you're looking at a target who historically hasn't bought those coverages. We used to be able to go in and buy what we call nose coverage, where you sort of roll it in and they look backwards. That's not a technical term, but that's getting increasingly hard to do as well. So I would say, I know everybody thinks insurance is boring, but it's actually a very vital and fast moving area of finance. And I would say right now, cyber, D&O, and anything to do with financial coverages, that's where you need to focus your risk and your diligence, because that's where everybody's going to be looking.
So, Roberta, can I just make a comment on what Emily just said, because I feel like it was really instructive for anyone in the audience who's thinking about selling their company. Because, so a couple of things. One is, I think some of my sell side clients, when we're negotiating an LOI, a term sheet, there's this perception that the insurance policy is going to be, what's the right word? A panacea. It's going to be a cure, right?
Yep.
And here's the interesting thing, and Emily will tell me if I'm describing this incorrectly. Insurance in the deal market, what's being covered is assessable risk. What's not being covered is risk you can't properly assess, and what's not being covered are known problems. And so to Emily's point, the insurance policies are a really good tool. JP was talking about, they're a really good tool for deal making, but they're not a simple cure-all, because what it does is it disciplines the buyer in a very objective way to have to do a thorough due diligence exercise on your company. And that's how you as the sell side get the full worth of your policy, right? Is by enabling that due diligence so that the underwriter doesn't exclude things from the policy. Now, in a macro sense, that's great. you open the doors, you facilitate all the great due diligence, and the policy gets written and everyone closes the deal, they're happy. But it's an arduous process, appropriately so, but it is an arduous process. And I think people need to understand it's not an easy ticket out of indemnity. And the other thing I would say is, I hate to date myself, but I learned about M&A. I learned it in 2006, 2007, leading up into the financial crisis and meltdown. And just to go all the way back to the beginning about Suzanne's point about how much dry powder there is out there, how much capital looking for a home that's going to express itself in the M&A market. Notice, even though that's true today, how much we just talked about due diligence and how careful buyers are being, even when they're looking to take opportunities in the M&A market. So if nothing else, maybe that tells us something about where the market is and how much there's still left in it to be tapped. Because there's not so much capital out there that people are throwing it around the way they did in 2006, 2007 on M&A.
Great point.
Thank you. And I apologize for the dog barking in the background.
Just grateful it's not mine and that she's,
Definitely made this panel a human experience.
It humanizes us all.
JP, did you want to add anything to that conversation?
No, I mean, listen, I agree with all that. And, to Kathy's last point there on due diligence, I mean, this is, a topic that we all know that's been around for, 10 plus years now. But I think things like the Theranos trial that just is going on in Silicon Valley and, now awaiting sentencing or whatever, those types of, bad situations, if you will, kind of reinvigorates, I think, deal teams, both on the buy side and on the investing side, to make sure they're doing their diligence, not casting any stones on that particular situation or that particular process. But, anytime there's a major failure in the system, it kind of reminds everybody that, hey, we may have insurance or, we have counsel, we have M&A people on the call, but we still got to dig into these things. So I agree with everything Kathy and Emily was saying.
So Kathy, I wanted just one more question to you in terms of this conversation too. I mean, you did speak a little bit about the velocity and even the volume of deals getting done, but I know there were some mega deals that happened. Can you speak of how you think those will impact the market? Will they not? Is it the same? I mean, that was one question I know that has come up that we wanted to address today.
Yeah, no, it's a really great question. I'll be curious to hear what JP and Emily think about it. So I thought Suzanne's presentation was great. I did sort of think, okay, how do you break down those numbers when you look at the total market activity? So, despite the market volatility, we're seeing deals like AMD just closed on Xilinx, right? Oracle just before Christmas announced an acquisition of, I think it's a healthcare data company, Cernice. There's a way in which I think those they exist at a different level. Things like Zynga Take-Two, which is more what I'd call existential public company M&A, or things like AMD Xilinx. I think they're going to keep going in a different, in their own world, so to speak. They're not irrelevant to the larger percentage of M&A, which is at different valuation points. They are relevant because, within a certain valuation range or within a certain vertical, people are going to look always to the public company to see what the peer comparables are. How does that, influence the valuation in the private company? I mean, but at the same time, there's a way in which the dynamics below a certain valuation point, which make up the vast majority of the overall value in the M&A market, even if it's not, each one high dollar value, the way AMD Xilinx is, those deals are operating on a different dynamic entirely. So, I think, and these are very bad numbers to try to throw out there, but if you're in the 1 billion to 5 billion range, I think you're probably getting heavily impacted by market volatility, because you're more likely than not going to have an identifiable public peer company group. And so when the bankers and financial advisors are looking there, they're going to see flux in the valuations. Also, the companies that are most likely to buy you, strategics that are publicly traded themselves, they're having problems potentially in their currency. Maybe they're not prepared to do, what for them may be a meaningful stock-driven acquisition. Below that 1 billion, the public market's not irrelevant, but there are other dynamics at play, I think, in the valuation and the reasons for the acquisitions that I think are just, it's going to move on different influencers and different vectors than, the mega M&A.
Emily, JP, did you have anything to add to that? I know Kathy mentioned you might.
No,
Go ahead.
Kathy, I think is 100% spot on. There's a strata that is very different, and she's also right about that sort of, the impact of the sort of comparison when it comes to the volatility, but I agree, the megas will continue in their own sweet way, but the more middle market, if we want to say less than $1 billion is a middle market, there's such complexity to the drivers behind those choices, especially when it's a strategic purchase. They're buying for so many different reasons and for so many different forms of value that it's not as impactful, because they're not buying a balance sheet or a single thing. They're buying for a multitude of different reasons.
I would just add 2 comments really quickly. So, agree with that. The smaller the deal, the less relevant multiples are. I think when it comes to valuation on that mid-market, part of the range where we play a lot, so have a lot of insights there. I mean, nothing drives valuation more than competition, right? And what you really need at the end of the day are several buyers at the table trying to acquire the company. And so you can push and prod on obviously valuation, but other terms associated with it. So I think the lower you go, the more important competition is. And then secondly, and we deal this often with, a lot of the smaller clients, is what I refer to as the lottery fallacy, right? You see some pre-revenue company just got acquired for $1 billion. So, well, I'm pre-revenue, I must be worth $1 billion, right? And that's not how the world works. And I relate it to the lottery, because you see the person who won $500 million in the lottery. You don't see the 500 million people who bought a $1 ticket and lost.
That is an excellent analogy. That being said, too, just to the group, we're kind of coming towards the end where we're going to start taking some questions and looking at some questions that we've gotten from the audience. But before we do that, I wanted to know, as a group, could you provide me maybe some key takeaways that you would like to, impart to the audience? JP, could you start?
Sorry, happy to. I was just trying to get my other device off mute. 2 things I would say. The first one is related to the competition that I just mentioned. In the same way that you're going to have, insurance in a deal, or you're going to have counsel, use an M&A advisor, use a banker. Nothing drives valuation more than competition, right? You could do it yourself, but if you're a CEO or you're a CFO or you're the chairman of the board, if you're going to paint your house, you're probably going to fall off the ladder and it's going to be sloppy, right? So use an advisor. That's what we do every day. That's what insurers do every day. That's what Wilson Sonsini does every day. We're here to help. And when we run a process, the goal is to get several buyers to the finish line at the same time so you can get that valuation up. Just as an example, a couple of our last deals, when we were able to move that valuation up, we paid for our personal, our fees for our, 10x and 13x time. So number 1, use an advisor. Number 2, I would say, try and get it done potentially this year. Last year, as I think Emily alluded to, this on the insurance side was this buildup for all these deals getting done in December, because at least within the US, we expected the tax regime to change pretty dramatically. Started off dramatically, and at the end looks like it was going to be a 5% delta on the long-term capital gains rate. Well, that got kicked down the road. And so assuming we can't do retroactive taxes, that tax increase is probably now going to happen in 2023. So if you can get a deal done in 2022 and say, even if you save 5 points, on $1 million, $100 million deal, that's $5 million in your pocket. That's not going to the tax authorities. So those are 2 leave behinds that I would leave with the group.
Thank you. Kathy.
I think JP's right. I'm going to take one of his points and actually make it a bit more granular. His point about use advisors. I know it's really easy for me as a service provider to say this. Use your law firm. I think CEOs, CFOs, boards really need to appreciate how hard it is, particularly for growth companies on the sell side, to both not just operate, grow the business, keep it on its growth curve, and go through a sale process at the same time. There is definitely an inclination, which is completely understandable, to try to save as much as you can in the early uncertain stages of a process by pushing very hard on your team. But particularly in the current labor market, my advice would be don't push too hard, be cognizant of the burnout, and use the professionals for what they're there for, which is to help you.
And just on Kathy's point, on top of my point, which was there's also and I know Kathy will agree with this wholeheartedly, there are going to be many very, very difficult conversations between the buyer and seller during the process. Heated discussions, to use a nice term, battles, if you will, over legal points, over financial points. And at the end of the day, the selling company generally has to go work with the buying company or the investors. And you want to make sure that you use your attorneys or you use your investment bankers to take those bullets. Because, at the end of the transaction, we generally go away. And so we can be wounded in those fights, but it's important that the, selling management team maintains a very positive rapport with the buyers.
That's excellent.
Yes. Yes.
Excellent.
And I will build on Kathy's point, which built on JP's point, that yes, absolutely use your advisors, and very much on the tremendous sort of strain it puts on an operating team to go through the diligence process, both on the buy and sell side. Our book is pretty evenly split between corporates and private equity, and corporates are much more inclined to do a larger percentage in-house. And that can be extremely painful for the people involved. And also, while there are areas where the corporate is excellent at the in-house and can really add value, think about the areas where it can be put off to a third party. Right? If it's not very specific and very specialist, get somebody outside to do it, and don't carry that burden yourself. And also, the more things change, the more they stay the same, right? Value is value is value. And the things that matter when there's a lot of noise about SPACs and multiples and et cetera, it's still going to be, people want to buy things of value. They're going to want to see a well-run company, and they're going to want to feel safe buying you, whether you are insured or not insured. So having a tight ship is always going to make for a much easier process.
Thank you all. Really appreciate this conversation. I'm going to open it up for some of the questions that we've gotten from the audience since we've started this discussion. So one is from Igor Zaks, and he is asking, does supply chain issues lead to more vertical M&A?
I will just say, I think it probably leads to more thinking about vertical M&A, because if you are a startup or a growth company and you don't have the scale of buying power to influence suppliers, I think it's a very natural strategic thought to wonder, okay, if you aligned with a bigger company, what could they help you do? It's one of the synergies to think about. They could help you ramp your revenue growth by helping you actually get the supply that you need in order to sell.
I'm not sure that the supply chain issues that we're seeing right now are going to be long-term enough that it will drive sort of M&A for the next year or so. I think there's still a sense, maybe rightly, maybe wrongly, that the supply chain is going to sort of sort itself out as things calm down. And so it's not a long-term problem, and you wouldn't necessarily solve a short-term problem with M&A.
I agree with those comments. I'd also say that I think the pendulum swings, right? I mean, in the last probably 50 or 100 years of M&A, which, far before any of us panelists were around doing M&A, but there's been moves towards vertical integration, and then that goes wrong. And then they, big corporates start to sell off different parts, and then they go to focus on the one thing that they're good at. And then that pendulum swings and, maybe we should vertically integrate again. So I don't think there's any one right answer there. I think it depends. But I would definitely agree with Emily from the perspective of, hopefully COVID is a 2-year blip on the history of M&A. And I don't think it's going to be a long-term driver of vertical integration.
Okay. So next question. Oh, Kathy, did you want to say anything additional?
Oh, I was nodding along thinking, thank you, JP, for not suggesting that any of us were doing M&A 50 years ago. I appreciate that.
I'm proud to say I'm the oldest one on the panel, so I'm okay with that.
So the next question comes from David Shaw. Will you all weigh in, at least from your perspective, opinions, et cetera, on the open Federal Reserve Board positions and proposed replacements relative to future rate hikes?
Well, I think that's a pretty broad question on the Federal Reserve Board, but listen, I think interest rate hikes are going to have to happen. I don't think they're targeted at M&A. I think I mentioned earlier, I think given the fact that we are at the lowest interest rates, I think in the history of probably the world, but I'm not quite sure. Again, haven't been around that long. But, certainly the last 7 years, I remember getting a mortgage back in 2008 at 6%. And I thought it was the greatest interest rate I've ever gotten in my life. And then, last year it was at 2.65. So it's, things have gone down to ridiculously low rates. At some point, the Federal Reserve, whether it's inflation oriented or just savings oriented, interest rates have to go up. And they may have a de minimis effect on M&A, but again, that would be the tail wagging the dog. I do not think interest rates drive M&A. They certainly enable M&A from a borrowing perspective, but they're not a driver.
I'm going to go to the next question, just because it's more specifically going back to the M&A piece. I think we'll take this one and then a next one. Oh, I think we'll have some time. So this is from Eric McLaurin, and he is asking, are most of the deals you're seeing, and this probably would go to you, JP, just because in terms of what you were talking about, the different areas that people are looking at in terms of M&A, are most of the deals you're seeing involve companies that have significant tangible assets or more intangible assets on a general percentage basis?
Well, I happen to lead the software practice, and so I do software M&A on a daily basis. So for us, it's mostly intangible, right? There's generally not factories or things along those lines. So again, I think M&A happens across every industry. I think the old school version is how do you a brick and mortar M&A company is going to be valued on EBITDA, where a software company that's break even but growing quickly may be valued on ARR. So I know it wasn't a valuation question, but yep. There's companies in every genre, and there's M&A being done across every single vertical. So I mean, it happens in both, whether that's asset heavy or asset light.
Kathy, did you want to add anything to that?
No, I think that's right.
Okay. We talked a little bit about this too, and this is from an anonymous attendee. just in terms of the great resignation. I think, Kathy, you brought that up in our conversation. So given the talent demand and things that are happening, are deals incorporating more robust key staff retention terms and or incentives in their M&A deals that are happening?
Yes. I feel as though I can't really say that much more, but I would say,
Okay.
I've seen on behalf of clients on both sides of the table, yes, this is becoming a critical risk factor in M&A.
Yeah, we've seen the same thing as well, and getting asked a lot more about key man and how broad that concept can be in terms of retention.
Okay. Another question here, anonymous. I'm wondering if anyone wants to touch on the successes and failures after an M&A deal, specifically where most companies succeeding or failing in the post-merger or post-acquisition perspective, and what can we look out or be aware of for, leading into the integration of two companies. I think they want to understand the success and failure quotient and how you're kind of measuring that, seeing that in the deals.
I mean, for us, obviously the success or failure is measured by claims. So, that's how annoyed somebody is post close tends to lead to more claims. And I would say that while claims are on the increase, I don't think that is a measure of people having more unsuccessful M&A. I think that's just a measure of there being more policies and people getting more sophisticated about bringing claims. So I wouldn't say looking at claims activity that there's more success or failure in any particular industry, or that while vast majority of claims are invariably around financial statements, that's an entirely misleading statement, because pretty much every claim is also a claim under financial statements. So what we do see is that there isn't a consistency of cause for unhappiness post-close. It's not like, oh, well, it's always the such and such that ends up being the claim, or it's always this that ends up being a problem. It seems that every deal is unique. And so I would say that success or failure is a bit more of a unique proposition, statistically, from what I'm seeing.
We did talk pretty intensely about engaging advisory in terms of an M&A transaction. But there was a specific question on how soon a team should engage their advisory before a planned transaction. Is there a certain time period that you would suggest? Is that more something that you think that they need to have a discussion with you? And that was from Robert Smith in the audience.
Well, if it's Robert Smith at Vista Equity, I think he's probably pretty well versed in
I don't think it's that
works.
Robert Smith. I was thinking the same thing. I don't think it's that one. I don't know.
But in case it's not, I would say that generally the earlier that you get, advisors involved, the better. Even when we're in a process, I always tell our clients, you need to run your company as though an M&A event is not going to happen, right? So there's, should I invest in this person, or should I invest in, this geography? You need to keep running your business as if M&A is not going to happen. And most people who start companies and build companies aren't doing it for an M&A event, right? They're doing it to provide value and build a company. But the earlier you get involved, the better, just because we can help guide on certainly when we're putting books together and actually going to market, that's a couple-month process to really get the materials together, marketing materials, tell the story, work the story back and forth between management and bankers and counsel and all those different things. So I guess, I know it's broad, but earlier is always better.
I think that's right. And I mean, to the discussion we had earlier, there's a natural reluctance to quote unquote overspend earlier in the process when it's less clear whether you're actually going to have a specific sale outcome. But For example, one thing that I think advisors can be very helpful on early in the process, and that isn't necessarily all that intensive in terms of fees and time, is just talking through what a sale looks like. What are the different outcomes or requests that you could see coming from a PE buyer versus what I'd call a true strategic buyer, an operating company. And, those are conversations that I think are fruitful to have both with the financial advisors and the lawyers. And again, not necessarily all that time intensive and therefore not all that costly, at least with the lawyers.
Thank you. We have one more question before we end today. It's going to be from Jill James. I know that there were some others, but we do have to start wrapping up here, everyone. So Jill James asks, have ESG considerations impacted any M&A approaches or targets that you've seen?
Roberta, what was the beginning of that question? What has affected M&A?
ESG.
ESG.
Oh, listen, I think ESG is certainly at least from a software perspective, ESG and GRC is certainly a vertical within software. And so we're actually, we just closed a deal on December 29th in the ESG vertical sold it to a private equity firm. So I think private equity and M&A associated with buying those types of companies to service large corporates, I think it's definitely a hot area from an M&A perspective. With respect to ESG or GRC internally, affecting a company that is potentially for sale, I don't see that as a big driver. I think if there's issues internally with ESG or GRC, those can, be addressed post-close. And I don't, again, it may be something that may be a little concerning to a buyer or a private equity investor. But I think it's also something they see that they could help fix post-close.
Agreed.
Thank you. Thank you, everyone. So happy to have been able to moderate this great panel today. Colin, I'm going to turn it back over to you.
All right. Well, thank you, Roberta, Kathy, Emily, and JP. That was a great overview of the M&A market. We're coming up on a quick break, but before that break, I'm going to launch a quick poll to just let us know if you want a follow-up meeting with everyone on our panel. Thank you, JP, Roberta, Kathy, Emily. All righty.
Thank you.
So I'm just going to launch this quick poll. And you want to learn more? Just click this button and we'll make sure that you can get in touch with who you're looking to. Let me launch that poll one more time. Sorry, folks. Relaunch poll. All right. Let us know if you want a meeting with the partners and panelists that you just talked to, and we will get back to you. But we've got a break coming up, so we hope you will join us for our next session, M&A Strategy for Early to Mid-Stage Entrepreneurs. We're going to return in 10 minutes at 10:40 a.m. Pacific Standard. So we look forward to seeing you all back then.
Right.
right, welcome back. For those of you returning or just joining us, we're going to open up for live Q&A at the end of this session. So please continue to submit those questions in the Q&A function at the bottom of your screen throughout the presentation. As you settle back in, we want to get a good indication of what you're trying to learn for this next panel. So in the next 3 months, how many of you are exploring M&A as an option? Fully looking into it, not quite ready, or here to just learn more? So let us know in that poll where you're trying to look, and that'll help our panelists that are going to be introduced soon know where you're looking to learn. Awesome. Thank you all for participating. I'm going to give this another 10 seconds or so, but it looks like fully looking into it is at the top of the key. So this is great. You're all here in the right place. So I'm going to just share these results really quick. Some people not quite ready, most here to learn, many here to learn more, and most fully looking into it. So you all are in for a treat for this upcoming panel. So the topic for our next session is M&A strategy for early to mid-stage entrepreneurs. Without any further delay, please join me in giving a warm welcome to our guests. Our moderator is Jared. He's an investor at Emerson Collective. We've got Tucker, who's a director at KPMG. We've got Catherine, who's a partner at Wilson Sonsini, and Luke, who's a partner at Private Equity and Transactional Risk Group at Woodruff Sawyer. Team, welcome. So happy to have you. Jared, over to you.
Awesome. Thank you, Colin. And good morning or good afternoon, everyone, depending on where you're calling in from. My name is Jared Barnes. I am honored to be your moderator for this incredibly important and timely panel. And given these results, I feel we have a great balance of folks who are ready to dive in, but also ready to learn more. So really excited to get into our conversation today. And more importantly, introduce our fellow panelists. Quick background on myself. As Colin mentioned, my name is Jared Barnes. I am an early stage investor with Emerson Collective. We are a multi-stage impact investment fund based here in Palo Alto, California. I spend the most time with our early stage companies, but also with our expert network and folks within the corporate development space, helping our companies prepare for their next steps, whether that is within an M&A or even transitioning. But I will go ahead and turn it to Tucker for an introduction.
Yeah, thanks, Jared. So I'm a San Francisco-based director at KPMG, the Big Four tax advisory and accounting firm. We offer a broad suite of M&A services for both the buy side and the sell side. And my specialty has been commercial due diligence and performance improvement in the technology industry for both corporate and PE clients. Prior to KPMG, I also worked in Corp Dev at Yahoo for some time and McKinsey as well.
Thanks, Tucker. And Luke, we'll go to you.
Morning, everybody. Luke Parsons here. I'm a partner and senior vice president at Woodruff Sawyer. I lead the private equity and transactional risk group for our private equity and venture capital clients as they look to make acquisitions or sell companies on both the buy and the sell side. Woodruff Sawyer in general is one of the largest privately held insurance brokerage firms in the country. And in any given year, we work with roughly 30 to 40% of the IPOs that price each year. So we're highly focused in the areas of pre-IPO companies, helping them transition from private company to public company on the management liability side. And then I spend a large majority of my time, like I said, helping our private equity clients on their buy side due diligence. So very happy to be here and looking forward to the discussion.
Thank you, Luke. And last, but certainly not least, Catherine, we'll go to you.
Thanks, Jared. I'm Catherine Riley-Zapori. I'm a partner at Wilson Sonsini in our New York office. My practice really ranges from working with very early stage companies, just starting with formation, kicking things off, early equity financings, all the way through exit. So mostly specializing on the M&A side, some work in the capital markets and IPOs, but really working with companies through their full life cycle. I started my career doing private equity work and then slowly transitioned into more of the tech venture growth company space. So I do have some of that private equity background, which is helpful when private equity is on the other side. But looking forward to this conversation and hearing what questions you guys have and how we can be helpful.
Thank you, Catherine. And please, if you have questions, feel free to drop them in the Q&A. But maybe just to start our conversation, with an open question to the group. We can talk about macro trends. How have you seen the sell side evolve at the end of last year, beginning of this year, late Q4, early Q1? What can this mean for folks within our audience that are looking to get acquired in the coming months over the next few quarters?
Yeah, well, I think, Jared, one of the things, we're seeing is, maybe coming down off a little bit, these kind of sky high valuations, but it still seems like a pretty good time to buy and sell. I know our pipeline is still strong, but not, quite as hectic and frenetic as it once was. So I think we expect people to, continue to invest the time. I think strategic buyers will continue to be kind of very important in this environment. And I think we'll continue to see kind of smaller companies using M&A to supplement their growth, using stock, plus cash to do that.
Yeah, Tucker, great comments. Jared, my response would be, I think the Q4 was, I don't know about you, Tucker and Catherine, Q4 for us was ridiculous. I think we as a team at Woodruff worked on more buy-side engagements for our clients than ever, as far as just one quarter's worth of deals. So I think largely January was a little slower. Now that we moved into Q4 or Q1, I think the things going on with the public markets right now, the SPACs and de-SPACs, that market is shifting just as quickly as it shifted last year when people got into it. I think there's just a lot of litigation and regulations coming out that are having a pretty big effect on that. But largely speaking, for the lower and core middle market companies, I think the private equity space specifically is going to be huge this year, just because I think a lot of companies are coming back, like you said, Tucker, they're coming back to reality on some valuation metrics. And I think it's going to be a really busy year. Now that January is over, we're already seeing deal flow uptick in February, looking into March, April closings. I also think that the tax issues from last year had an effect on deal flow. Everybody wanted to get the deal done before the end of the year. And once we found out that the taxes weren't going to be that big of an issue or that big of a change, everybody just wanted to enjoy the holidays and kind of punted to Q1 deals is what we saw. But we were still busy, like I said, going up to the last day of the year. There were several firms and deals that needed to get done prior to the end of the year. So I think we'll see that trend continue now that it's picking up again.
I couldn't agree more with what both of you said. Right on point. I think one thing I would add is we have seen in kind of the early Q1 January timeframe with all these valuations dropping, we have seen some deals have to reevaluate the valuations on the transactions, which has caused some hiccups in transactions. But that seems to be settling out now, and like both Tucker and Luke said, the valuations have come back to reality, and that seems to now, with the deals that are spinning up, no longer be an issue. Everyone has kind of rechecked themselves for those transactions, but still a really healthy market in the M&A space, and not expecting that to really change.
And maybe, Catherine, to build off that last point you shared about the market coming back to reality, couldn't agree more. And maybe the $1 million question to build off of that is, when is the right time to think about selling? If I'm an entrepreneur, a founder, CEO, I've been building my company for some time, when is the right time to think about that?
It's a great question, Jared. And I would actually flip that question right back onto any founder, CEO, and say, when do you want to sell? Right? There's not really a right answer. Watching the market and trying to get the best deal price is not always the best way to strategize for a company. You got to think about what your trajectory is as a business, what your plans are, what your valuation expectations are in the coming months, your runway. And frankly, one of the biggest considerations is, do you want to stay in the business? Do you want to be, the founder and CEO of a growing company? Do you want to join a larger conglomerate, or do you want to get out? And those are often some of the biggest questions that our founders are thinking about. But really, the right answer is start exploring when you're ready as a company.
I couldn't agree more. We're going to talk a lot about the transaction process and what goes into that. But I think the point you made there in really identifying within yourself and what it means for your team, we'll talk about that a little bit more later. But maybe Tucker, to you, when you're in that process, what things do startups need to focus on when it comes to due diligence for an M&A process?
Yeah, I mean, I definitely would say that, important for kind of founders and executive teams to kind of keep running their business in the meantime, right? Because regardless of whether the transaction closes or not, that's going to kind of put you in the best position either way. And then beyond that, there's definitely a piece that it's kind of crucial to understand, what the deal theses, right, on the other side of the table are likely to be, right? So is someone going to buy you, because you're growing, because you can increase their share, because of your talent, because you can increase the way that company is innovating? So just being cognizant of that and making sure that as you start, supplying your materials, building your underlying metrics, you stay kind of laser focused on, what that kind of type of buyer is going to be interested in. That'll kind of make the process increasingly, seamless for everyone.
Thanks, Tucker. And maybe Luke, to you to take that a step further, right? I'm gathering my materials, but what if I may not understand how reps and warranties, insurance works? Is it beneficial to start thinking about that? When is the right time?
Yeah, it's a good question. I think reps and warranties largely will likely be a conversation you're going to have with your legal counsel when you're going to approach the market. Certainly, if and when the company reaches a valuation of 50 million or more, it's definitely something as a seller, I would say any prospective buyer should include a reps and warranties proposal in their bid. So taking a step back, what is reps and warranties? What is a reps and warranties policy? It looks to replace or augment the indemnification and corresponding escrow within a transaction process and within a purchase agreement. So it's essentially breach of contract cover for the reps and warranties that are included in an agreement. And they do that. The main reason, candidly, why sellers would want to include a reps and warranties package in their process and solicit one that the buyer would obtain is because it allows the seller to walk away more cleanly at exit with 99.5% of proceeds or 100% of proceeds, depending on how the reps and warranties policy is structured. That's more cash at closing is always best for sellers, and that's typically why they want to do it. But there's also a variety of other reasons, whether it streamlines the deal process, makes everything a little bit more seamless, the negotiation simpler if there's an insurance policy to backstop any kind of indemnification or escrow arrangements under the purchase agreement. But yeah, I would say largely speaking, reps and warranties policies have been the norm for several years, and on I would say every transaction above $50 million of enterprise value, we're seeing it and soliciting it for clients on the buy side and or the sell side.
Luke, that's a fantastic point. And I don't know about you all, but I've seen many transactions over $50 million lately, whether that's in TechCrunch, Crunchbase, all over the press. And Catherine, back to you, right? We may read about these transactions we see in the news, but we often know many of these actually don't go through. Right. And from your perspective, where do you see deals get stalled?
Really great question. I think the most commonplace, or not even the most commonplace, the most common way that deals get stalled are by not going through the process with any sort of forethought and patience. I think is one of the biggest things, right? We often see founders and management teams wanting to get to the finish line so quickly that things get left behind at the beginning, when really you want to be setting the foundation for a good, smooth transaction. And that kind of comes in two big buckets, I would say. The first one is the LOI, the term sheet. Engage your counsel early, talk to your advisors early at the LOI, take the time, negotiate that LOI, make it fulsome, include the indemnification provisions, include all of the terms that are going to be significant throughout that negotiation process up front when you're in shorthand and you're not worrying about the legalese and what the document says. That's going to make the back end of the process so much smoother. The other piece of that is in diligence, right? We often see that founders and management teams are really underwater, and a transaction just adds so much to their plate, right? And so you're trying to find ways to limit the amount of diligence that's getting put out there. But as a management team, what a buyer wants to know, right? Get that out early. Have a really early call where you're just talking about the things that keep you up at night, the things that are issues for a management team. Be open with the buyer about those things, because those are the ones that are going to come up at the last minute, and the buyer's going to want special indemnities for it because they won't be covered by rep and warranty insurance. And those are the things that are going to stall a deal and change the valuation, change your outcome. So get ahead of that at the beginning. Really work with the buyer, have these open conversations, and don't try to rush to the finish line so quickly. It'll come faster if you're patient and having those open conversations. We almost always see deals stall out at the end because unexpected things came up where the parties hadn't had those conversations at the beginning.
And that's a fantastic point of transparency being such an important part of this process. We see the same thing from a venture capital perspective, in earlier stage as well. And maybe Tucker, to you, given your experience within corporate development, what do these conversations look like with, being in the buyer seat? And, I'm sure startups and companies don't just come to you saying, hey, would you be interested in buying my company? What is it that founders and startups can do to position themselves in an attractive way to a potential buyer?
Yeah, I mean, I'm sure folks have heard the adage before, right? Companies get bought, right? Not sold. And I definitely think that's true. Maybe just kind of two things to think about. Number one, I think building a really kind of like robust, successful, growing business is, makes the conversation, the easiest, and putting the right kind of metrics and business management in place to make unpacking the underlying operations and really understanding how the business is operating really easy for an acquirer is probably, one of the best things you can do. Because, not every buyer will do this, but a lot of them, and certainly a lot of the ones that work with us, will poke and prod kind of on every kind of key metric that underlies their investment thesis. Whether it's kind of AAR, cohorts not growing, recurring revenue cohorts not growing like they once did earlier in the growth phase, to, your customer acquisition costs changing. It could be anything, right? So just getting those metrics in place, underlying, robust kind of business growth. And then the second thing might just be to be easy to work with, right? At some level, you're going to have to set expectations, with your management team, right? And help them understand where this process is likely to go. And you're going to want to be a good partner, right, with a buyer throughout this process.
I couldn't agree more. There are certainly metrics that are critical to this, but even more within that is the human aspect, right? And the human element to all of this. So I couldn't agree more. And, the prospect of having your company bought, as you mentioned, is really exciting, but there's also a high element of risk to this as well. And maybe Luke, back to you. How should companies think about risk when they're considering being bought, or considering, did we lose? I think we might've lost Luke. I am not sure. That's okay. Well, maybe Tucker or Catherine, either one of you, how should companies think about risk when it comes to being acquired?
Yeah, I can jump in here. I think there are a number of things to think about. One of the biggest of which has already been mentioned, the time that goes into an acquisition. This isn't something to take lightly, right? Like the day job of your management team is one that is significant enough already. And when you're adding an acquisition into the picture, you're really adding a second job. It is a lot of work, and a lot goes into these transactions. And so thinking about the risk to your business and to your day-to-day operations of undergoing an acquisition process, and that's not talking about, a huge, massive auction process only. Like that is any acquisition process, right? Even the smoothest of processes take a lot of time and effort of your management team. And so that's one of the biggest risks to companies is how disruptive something could be with the potential that it not close. And then, of course, you have the actual risks associated with the deals that are negotiated. So things like indemnification that survive the transaction. And that's where reps and warranty insurance comes in as a great thing that has been, very, very prevalent in our deals recently. And we see them specifically in the larger deals, but also in the smaller deals as well. Rep and warranty insurance has become an essential part of transactions to help remove that sense of risk to selling shareholders on an ongoing basis. But that is certainly something that you want to be negotiating right up front and talking about right at the beginning. And it's something that we often see not discussed at the beginning of transactions. And then as soon as you start talking to your major shareholders, that's the only thing they care about. And so, having those conversations early and understanding the risk that your shareholders are going to be taking on from the transaction is important. And I see we got Luke back. So Luke will have, I'm sure, some thoughtful insights there.
Yeah, well, as Luke's getting back logged in here. Oh, I think here he is. Can you hear us okay, Luke?
Yes, hi. Sorry about that. I'm ashamed to say after 2 years of this, but it was a technical difficulty. I'm back now.
No, well, we were just talking about risk, and one of the risks is when your Zoom crashes in a panel, but that's okay. No, we were talking about risk and things that founders specifically should consider. Any insight you'd be open to sharing when it comes to risk and thinking about an acquisition process?
Yeah, no, I think it's a great question. What we tend to find when we're doing diligence on the buy side, or if we're engaged in a sell side engagement, I like to say this to my clients: insurance is a top of page issue. It's just the top of page 3 or 4. It's never the highest priority on the list. But there are myriad things to think about when a company is thinking about selling itself and prepping itself for sale. One of the things that I would recommend prioritizing is making sure that the company has a solid foundation of insurance, whether that's property and casualty or core liability coverages, or now recently, as I'm sure everybody listening in and the other folks here on the webinar or on the call can attest to, cyber is getting to be a large risk that every buyer is going to look at. So having a well buttoned up and solid foundation of things like cyber insurance. What we tend to find is that a company is usually mitigating its core risks like your property and casualty or your product liability. What we find that maybe the management team hasn't implemented when we get involved or when the decision to sell comes up to the table is that they haven't done some of the other more nuanced specialty coverages like cyber liability, professional liability, errors and omissions, things like that. And what I'll say is that on the buy side, any potential buyer is going to be doing their due diligence on the insurance and risk management program in place. So for them to be able to check that box that everything is good to go and there's no major red flags or even yellow flags associated with the underlying insurance program, it's going to be an easier process from that side. And again, as Catherine said, there's a lot of things going on. So the lighter the lift can be on management during the process, the better. And insurance is one of those things that can create some issues if they've got to go look for things or put policies in place, either pre-close or at close. So that's what I'd say. When a company's thinking about risk, we think of it as the actual core business risk associated with the business.
Those are all fantastic points. And I may think, just to echo what you shared, there's so many subtleties in this process, right, that could trip you up as a founder. And maybe just to build on that a little bit further. And Catherine, you mentioned it just in being overly transparent, but maybe Tucker, to start with you, and for each of you specifically in your domains of expertise, where is it that you find yourself sharing the most advice when it comes to M&A? And Tucker, we can start with you.
Gosh, I think just kind of given I do so much work, on the commercial diligence side in technology, it seems to be all around kind of business performance and business metrics and helping sellers understand, what buyers are looking for, in terms of just kind of understanding the business. So we'll get a lot of questions around, how we see, more mature companies doing things like, managing their underlying metrics, managing their teams. So, I think a lot of kind of advice around, how you grow up as a business comes out of some of those conversations related to commercial diligence.
Catherine, how about you? Where is it that you find yourself sharing the most advice?
That's a really good question. I think we would see probably most of the conversation on our end really around risk allocation and allocating amongst the parties on a post-closing basis. That's really where a lot of the conversation around deals on the legal side comes in. And so kind of thinking about and understanding at the very beginning of your transactions what your risk tolerance is and what the risk tolerance of your employees, if they're going to be continuing employees with the buyer, as well as of your shareholders, is an important first thing to understand.
I think we're still getting Luke back, but I think both of you, Tucker and Catherine, shared phenomenal points. And one other aspect that I think we haven't hit on is the underlying layer within all this is there's pretty heavy competition, right? Both on the sell side and on the buy side. And maybe Catherine, back to you. As a founder, as a startup, what is your perspective on protecting competitively sensitive information through this process?
Yeah, I think this is one of the most important things to think about early in the process, right? Is how to protect your information, and I apologize if you can hear barking in the background. We have workers going on outside, and my dog is unhappy about it. One of the first things that you're going to do as part of a transaction is negotiate the confidentiality agreement, the non-disclosure agreement. And the provisions in those, a lot of people think of them as boilerplate documents, but they're not, especially if you're talking about an acquisition with a strategic buyer, right? There are real concerns that should be addressed right up front in the NDA, and involving your counsel in that process will make it much smoother. NDAs are something that we see all the time, and with the repeat players in these transactions, whether that be strategics or financial buyers, we all kind of know the terms and the games that are played amongst the NDA provisions, and it'll speed up the process if you're going counsel to counsel and help you allocate that risk. One of the big things that does come up in NDA negotiations is to think about from a competitive standpoint is if you are looking at strategic buyers, thinking about your non-solicit provisions and including those in NDAs. Buyers don't like them, but it is helpful and frankly necessary if you're talking about a strategic buyer or a number of strategic buyers in a bid process. It is pretty necessary to include those to protect your team and to feel comfortable moving ahead with the transaction in a more open, transparent way.
Great considerations. And of course, there's a lot of minute detail to that, but thank you for that helpful perspective there. And maybe to go on the other side of the table, both you, Luke, and Tucker, buy-side diligence. Can you walk us through that process? Where have you seen things go right? Where have you seen things go wrong? Maybe for folks who aren't overly familiar about, what goes into the buy-side diligence process, maybe Luke, we can start with you, and then Tucker as well, on just what that process looks like.
Yeah, sure. I think so. Overarching 10,000 foot view. I mean, a good buyer and who has a good process and has good legal counsel on their side is going to look at everything. They're gonna try to find any possible thing that they can that could negatively impact the EBITDA of the business post close. They want to grow the business. They want to see it grow from start to finish, and anything that could negatively affect that. Our job on my side of the equation, on the insurance side, is we look for the landmines that could negatively affect that EBITDA. And then once we identify those landmines, we identify ways to fix them, whether it's something is deficiently covered, whether it's not covered. We identify ways to cover it on a post-close basis to protect the buyer and their investment, whether it's private equity or strategic. I think that's our core job, is to identify where those areas of risk are and whether they're currently being mitigated, acceptably being mitigated, or transferred to an insurance company, or they're just not being touched at all. A good example of this, typically founders or small but growing businesses are just growing at a pace that is, they just don't have time to think about the insurance program. So an insurance program that they buy on in January, they put on the shelf because they have insurance, they don't think about for another 12 months. The business could have grown 5x in 12 months. So the insurance program that was put in place isn't the same program. So buyer is going to look for that. they're also going to look for tail exposures. Most buyers are going to want the company to continue to take care of any liabilities or anything that happened before their watch started, before they acquired the company. So we help folks do that as well on the buy side. Again, our whole job is to mitigate losses of EBITDA post-close of the business being acquired.
Fantastic points. Every time I want to build on something, I'm like, man, you guys, you hit it all. And Tucker, maybe for you, from your perspective on buy side diligence.
Yeah, so I think as Luke may have mentioned, our engagement tends to start with a pretty substantial kind of ask, right, from the sellers in terms of the data request. And there are elements of that are pretty consistent, right, that folks are going to look at in a lot of deals or most deals, financial reporting, tax elements. And then there'll be elements of that are kind of very custom, right, to the specific deal that's being contemplated and the investment thesis of the acquirer. So depending on the deal, we'll look at everything from synergies, right? How do we think we can bring these businesses together to create, to take out cost, to the underlying market and growth opportunity, right? So, hey, if we wanted to bring this product, to a new market, what would that look like? How much would that cost? And what do we think the buyer could kind of gain from that investment?
And to build on that further, Tucker, for you as well, have SPACs impacted that perspective and maybe the market as a whole?
Yeah, I mean, I'll let others weigh in here a bit, but my sense is we're a little bit past the kind of the hype cycle on SPACs. There's a lot of undeployed capital still out there, but new rules are coming this spring. There've been a lot of canceled deals. I think we'd expect them to settle in, alongside kind of IPOs, as part of the ecosystem. But, PE-led deals, strategic M&A will probably continue to, be really important in terms of volumes.
Luke, I saw a look on your face when we mentioned SPACs. Any thoughts there as well?
Tucker hit the nail on the head, I think. So Woodruff works with SPACs a lot and manages a large portion of the SPAC IPOs. And we work in tandem with, or the folks on the IPO side work in tandem with my team because we work on the de-SPAC side of the equation. So we've seen our fair share of busted deals. And I think the market is largely seeing some companies that are going through a de-SPAC process maybe are not ready to be publicly traded companies. And I think a lot of people have these aspirations of their own valuations, and SPACs were a method of getting to the valuation that they were seeking. And I think as Tucker mentioned, I think the hype is kind of dying down there. I think the regulations will be stark that come out in the spring. I think it's going to have a big impact, and there are, I think, 500 plus SPACs out there that still need to do a deal in the next 2 years. So I think it's going to get a lot worse as far as litigation and things. So I think that's going to weigh heavily on people's decision, whether it's buyers or sellers, and whether or not, one, they want to launch a SPAC, and two, on the sell side, whether or not they want to sell to a SPAC, just based on the historical performance to date of the post-close merger.
Couldn't agree more. And we've hit on so many key points throughout this journey to M&A. And one of the other key points that, from my perspective, consistently comes up is, how should I price my business? What is the right price? And then that is another of the multiple $1 million questions we've hit on. That is another $1 million question. And I think, I can briefly share from a early stage investor perspective. Luke, Tucker, Catherine, if you'd want to share from maybe a later stage perspective, please feel free to chime in. But if you think about it from a corporate development standpoint, right, what I've seen is folks take a true barbell approach, and you see folks optimizing for fit and really implementation and integration into the business. The transaction simply is a byproduct of that. But one of the key questions for founders to really, and startups to really think about, is what is the underlying valuation methodology that this company is using to value my business? How are they getting to this number? And this is a great opportunity to look and understand comparable company revenue multiples, how much they were acquired for, what was that transaction. If you have access to a database such as PitchBook, Crunchbase, Capital IQ, those are all great resources to really look at and dive into to understand not only historical acquisitions and the price, but also what the revenue multiple was, and specifically how that might inform the buy side as well. Those are all things to really consider. Obviously, with the current market we've been in, it's beginning to cool off from a valuation perspective, but a key thing to understand is really the methodology that is being utilized. Tucker or Luke or Catherine, any perspective there from a later stage perspective, or finding the right price?
Yeah, Jared, I'll start. I think you had some fantastic points there. And so from my perspective on the insurance side, I'm lucky. By the time the deal comes to my desk and my team, that's already taken care of. So, I honestly, I wouldn't want to speak my personal beliefs, and I don't think I'm really in a position to make very many comments about that. But what I will say is it's very important to hire expert advisors like KPMG and Wilson Sonsini that can help you think through all those processes when you're thinking about doing that kind of thing.
Appreciate the plug, Luke. That's really helpful.
Yes.
Yeah, one thing to consider with a later stage company, particularly when you're talking about later stage private companies, it is, of course, common to look at any competitors that you have that are on the publicly traded markets. And so that is why we're seeing some interesting changes in valuations right now, particularly in the later end of the growth stage company cycle. Companies that are looking to exit that just had a bunch of competitors go public through de-SPACs is a really common space right now where we're seeing valuations be renegotiated. So something to think about when you're later stage and there are comparable companies on the listed exchanges.
Yeah, I would definitely just kind of second what kind of Catherine and Jared said there. Typically, buyers, they kind of have, anchor to a multiples analysis and then do the kind of reconciliation from there, right? Understand how your business is different, from the most comparable businesses where there's, clear visibility to the valuations. I think the only nuance there is, what kind of happens in the throes of the M&A process itself does also kind of clearly influence, the valuation, right? So the number of potential buyers, for instance, their kind of level of excitement around your business, right? I don't think you can understate, beyond the spreadsheet, how much of that just kind of influences the ultimate outcome.
Well, we have covered a lot of ground in a relatively short amount of time. This has been a lot of great information. And maybe, Luke, we can start with you. If there was one thing you would want a startup or a founder to leave this conversation with, whether that was, advice on the M&A process or a key thing you've seen go wrong in the process, what is one thing you would want someone to take away as it relates to M&A?
Yeah, it's a great question. My overall recommendation is build a deep bench of expert advisors. A lot of clients that hire us and come to us for help, their expertise is not law. Their expertise is not accounting. Their expertise is not tax. Their expertise is not insurance. They've been solely focused on building and growing their business, and that's great. So let the advisors advise you and help you build a good story and a compelling story and prepare you for the sale of your company. So when you do decide to sell, it is more of a streamlined process and a little bit less clunky than it needs to be. Personally, I think that includes hiring an expert insurance advisor, because a lot of times our clients, when they come to us, they don't know what they don't know. They don't know what questions to ask, whether it's on cyber liability or how this risk is covered or how that risk is covered. And it's important at an early stage to have a good foundation of insurance and risk management in place. And my team helps clients do that on a daily basis. So that's what I'd say.
Fantastic point. And maybe Catherine, to you, one key takeaway.
Sure. I would echo what Luke said. You engage your advisors early. That's one of the biggest things in having a smooth transaction and having the transaction move efficiently and quickly. We see a lot of companies, particularly early stage companies, that are worried about having fees and bills early in the transaction. But I can't say it enough how much of the deal is actually negotiated in those first few conversations and in the LOI. It really is critical to engage your advisors up front. It also creates, it sets the foundation for a smooth process when you're not trying to do everything on the deal, including negotiate all of the ancillary terms, engage, rep and warranty insurance brokers, move ahead with all the different steps that aren't on the forefront of your mind, but will be on the forefront of your advisors' minds, right? If you're trying to cram all of that into the back end of the deal, that's going to cause deal delays.
Such a critical point. And Tucker, to you, one piece of key advice.
Yeah, I mean, I guess I would third what Luke and Catherine said there, maybe just the opposite side of that, which is, what you have kind of done, right, is very kind of energetically, right, focused on kind of building a business and growing the business. So let the advisors do what they do. And, as you go through the sales process, you can think about it as an opportunity to keep kind of growing your business and growing up as a business, right? A lot of what is going to be asked of you, right, are the same sorts of investments, that would serve you either independently, or as part of a different company, right? So, just keeping your eye on kind of growing the business, growing up the business, right? Getting the kind of underlying metrics in place that you need to run it more effectively. I think that will, serve you well in deal process and beyond.
Couldn't agree more. We've had some phenomenal questions come in, and we're going to jump into Q&A. And I think maybe to echo and add on to what each of you shared from an early stage investor perspective, and as someone who works with a lot of startups acquiring other startups, right? One kind of pitfall and area that I would strongly consider is really managing this entire process of everything that we talked about, from initial conversations to the closing of the deal and the transaction, really making sure that you are in the driver's seat as a founder, and really focusing on not necessarily creating a false sense of urgency through the process. We've seen this consistently within venture capital. If you say, hey, we're looking to close by X date, and if you're not in by X date, then we're going to move on. And if it doesn't close by then, you can lose credibility. And so really considering how exactly you want to manage the process, and more importantly, what success looks like for you, and being clear about that up front. So again, thank you, Tucker, Luke, Catherine, for some great perspective. We're going to jump into Q&A. We've had a few questions submitted. I'm going to share first one that came in from Jonathan. And Jonathan, thank you. He said, do you see buyers reluctant to do rep and warranty insurance, and how do you address that as a seller? Also, do you see rep and warranty insurance in international deals as much as you do in the US? And Luke, maybe we can go to you for that.
Yeah, sure. So reps and warranties insurance is and has been for the past few months in its first real hard market. I think there are several issues that go into that. One is just general capacity, and two is claims have been mounting. So that led Q3, Q4, especially one of the actual first hard market in recent memory. I have been doing this for 8-9 years now, and in 2015, you were coming to the table, and the reps and warranties insurance was a differentiator to try to win a deal on the buy side. Now it's table stakes to participate in a process, typically in an auction process, even with the strategics. But since 2015, this is the first really hard market. So the reluctance of buyers sometimes right now is just cost. And sometimes the reps and warranties, because of the frothiness of the market and how busy the market is, how many deals are out there right now, the reps and warranties underwriters have been a little bit slower to respond, and as they jump around from different insurer to different insurer, so the timing becomes an issue. A year ago, we were seeing rates in the 3 to 4% range of the total limit. Now it's more like the 4.5 to 5.5 to 6. So buyers are getting a little bit more reluctant to deal with that, in addition to all of the other extra diligence steps they have to go through in order to put the policy in place. As far as UK international deals go, I think it's been a staple of UK deals for many years. I don't see that going anywhere. It's much more of a streamlined process over there, a lot less nuances in the policy, a lot less negotiations. But if it's a US based entity making the acquisition, it's been ingrained recently that there needs to be a reps and warranties policy in place if the deal is over 50 million. Those would be just some initial comments I would have. Catherine, you probably see this a lot too on your side of the equation. Does that jive with what you see as well?
Yeah, absolutely. I think rep and warranty insurance has become a critical piece of transaction negotiation, and especially when you're talking about those larger numbers, right? Like that, it's become nearly essential. We have seen some busyness factors, as Luke was indicating, over the last few months. The insurers are just wildly underwater, as is pretty much, as it has every service provider has been. I mean, some of you who have been doing transactions or trying to make filings, this is something that your lawyers have been seeing, and you may not have been, but even the state of Delaware has been having massive issues with filings, having to close down parts of their systems, right? So this has been across the board. This is certainly not exclusive to the insurance providers, but it is something that we've been seeing. I think it's still very much a part of the conversation, and that hasn't changed at all with the busyness. And on thinking of 3 cross-border deals I have going right now, rep and warranty insurance is in all of them, and it varies depending on who the buyer is and the jurisdiction that you're talking about, whether it's more of a U.S. style insurance-based deal with U.S. insurers, or if it's going to be in the jurisdiction in which the entity is based, and that does change the conversations around timing and process and what they need, what goes into it, what do they want to see. Those are all big factors, but that's a conversation to be had primarily with the buyer.
Really, really important areas to consider and think through, especially, once you pass that threshold of a 50 million valuation there. And maybe another important area to consider, we had another question come in, at maybe a negotiation point of how are typical earnouts and performance metrics for founding teams structured within a deal? Maybe Catherine, we can start with you, and Tucker, Luke, any perspective you'd be open to sharing as well.
Yeah, so the short answer here is there is not a typical structure for earnouts. And it largely is dependent on industry and the motive behind the purchase, right? So if you're talking about something that's more like an acqui-hire, where the buyer is looking to get the people and some portion of the business, but otherwise, it's really about the people, you're probably going to see some incentive, equity, and earnouts that entice the team to stick around. When it comes to a true buyout of a business where they're really looking to fully absorb your business, your IP, earnouts aren't going to be a critical part of the deal. So you're going to see more of the earnouts on the side where your business is going to be ongoing. You're just getting kind of subsumed, but the management team is staying intact. The team is staying intact. That's where earnouts are going to come into play. We have actually seen a lot of pushback on earnouts from some stockholders as of recent times. That earnouts introduce a lot of risk to your stockholders, and if the company is doing really well, they're going to really steer you away from them. Earnouts are becoming a little bit more of a distress situation, not exclusively, but particularly with companies that are a hot buy, you're not going to want to see the earnouts in there, and your stockholders are going to push back on it.
Points of negotiation along the process, and maybe to speak to that on a broader sense, when it comes to negotiation, what are some core things, earnouts, performance metrics being one of them, maybe Tucker or Luke, from your perspective, are there any other points of negotiation throughout the entire life cycle of a transaction that founding teams should really consider if they're newer to the space, or they may not have strong advisors in their corner?
Yeah, it's an interesting question, Jared. A lot of that negotiation happens kind of downstream where we typically, touch a deal. So I'd be interested to, hear if Luke has other thoughts there, but I totally agree with what Catherine said around earnouts.
Yeah, I totally agree with what Catherine said as well. And I agree with Tucker. I point this way because he's this way on my screen, sorry. But that's a little bit more downstream and negotiated before we ever get involved in the transaction process. So very much a legal discussion, I think.
Yeah, I'm happy to jump in on this one. I think this goes back to that key point where I was saying, involve your legal advisors at the LOI, because this is, really some of the things that get the most forgotten are the most negotiated points. So I would say hands down, when an LOI comes to me, I would say 95% of the time that LOI does not contain closing conditions and indemnification provisions. It makes a general statement that there will be indemnification provisions and that there will be closing conditions. That is not helpful to anyone. And those points are really going to be the points that you ultimately care about down the road, right? That is your risk post-closing, and that is a risk to deal actually happening when you're talking about what is going to get you from negotiating the business deal to a closed deal. Your closing conditions are key. And those are 2 points that are left out of almost every LOI. Everyone's focused on the purchase price and what's going to happen to employees and earnouts and everything around valuation and money. And those are all great points to be focused on, but you don't want to leave out the things that do bring risk to your shareholders and to the deal actually happening.
Such great perspective. Thank you, Catherine. And I know we've been talking kind of big picture, macro to M&A as a whole. We did have one question come in that was a bit more sector specific, specifically looking at manufacturing and distribution firms that are focused on physical goods, but any perspective that might be helpful to someone within the manufacturing or distribution business that is looking to sell.
Yeah, it's not my area, Jared, and I don't think it's Catherine's or Luke's either. I think that their recommendation to talk to someone that knows the space and knows what's happening in that space is probably the best recommendation there.
Yeah, I agree with Tucker. The person asked that question. If you want to talk about insurance on that side of the equation, more than happy to. I've got plenty of clients in that space, both portfolio company and non-portfolio company. But as far as valuation, I can't add any commentary.
And Jared, I think this brings up a really important piece. We've talked about engaging your advisors early, but also making sure that your advisors are in the space that you work in is key. You do not want to be working with, attorneys that are in the oil and gas business if you're a commercial tech company with, selling your SOS platform. Like that is just not where you want to be. And so making sure that you're engaging with advisors that work with companies like you.
Could not agree more. That is also not my area of expertise. So no. Oh, go ahead, Luke. I didn't mean to cut you off.
I was going to say, I couldn't agree more. It should be your after your prospective new advisor gets done introducing themselves. Your first question should be, tell me about your experience in XYZ sector.
Yeah. No, and honestly, the last question that came in was from an attendee that asked, if a founder has been self-funded and not raised any external capital through the company's life, are there any special considerations in exploring a sale?
Yeah, I mean, I think, what we see with self-funded businesses or family businesses, frequently this is a kind of a new degree of scrutiny, right? That happens on the business that they haven't seen before. So I would just, suggest that, one of the things we've seen a few times is just, folks can get a little bit defensive, right? About kind of all this questions. And frequently there'll be a team of, a half dozen, a dozen people on the other side, asking X, Y, Z, the other thing, more about kind of every element of the business. So I think just trying to be kind of transparent and understand that everyone is just, trying to understand, your business as well as you do and make a deal happen if it makes sense is probably good advice for that.
This has been phenomenal perspective. Catherine, Tucker, Luke, thank you so much for the time and for the insight. Last question. If someone wanted to reach out to you to learn more, to build on this conversation further, what's the best place to reach it? And Catherine, we can start with you.
Yeah, sure. So if you go directly to the Wilson Sonsini webpage, you can find me there, search my name. It'll pop right up. And otherwise, feel free to send me an email anytime at crileyzapori@wsgr.com. Just my name right there. So.
Excellent.
And
On my
Tucker,
side, the Woodruff Sawyer website has lots of blog posts that are helpful that I've written on the M&A space and insurance related to the M&A space. So I would encourage anybody to take a look at our Insight blogs page. All of my contact information, email and phone number are on each of those articles I've written in the past. Email is lparsons@woodruffsawyer.com. And I'm more than happy to have any conversation that any folks who are on would like to have.
Yeah, same here. Google the question you have and the letters KPMG and you'll find a half dozen articles on it, hopefully. But you can also reach me at my email. It's just tsarenbetts@KPMG, or similarly to Luke, if you just Google me, there are kind of several articles with my contact info on them.
Awesome. It looks like we had some stuff already dropped into the chat there, so please feel free to jump in. And if you are not ready for M&A just yet, but seeking additional venture capital, you can definitely reach out to me. My name is Jared. It's just Jared, Jarrod, at emersoncollective.com. But thank you all for attending. I will turn it back to Colin and the Nasdaq team.
Wow. Well, thank you so much, Jared, Tucker, Catherine, and Luke, for sharing those incredible insights for our early to mid-stage entrepreneurs. We do know that it is a very complicated system, but you guys covered so much. So thank you. Really, really appreciate all of your time. And thanks for providing that contact information. For those of you who may still have some questions, I'm going to launch a quick poll. Just let us know if you'd like a meeting with our partners. But Jared, Luke, Catherine, Tucker, thank you so much. And we look forward to staying in touch and hopefully having you back at the next IPO Bootcamp. So I'm going to do so I'm going to launch this quick poll. And just in case you didn't get that contact information, then you can put your info in here and our partners will reach out. We're coming up on a 10-minute break. Might get a little bit more time in there due to our schedule, but thank you for participating in this poll. I'm going to share those quick results. And Jared, Catherine, Tucker, thank you so much. Luke, all appreciate your time. Sorry. And before we transition to our last session, we're going to take a quick 14-minute break. So take a moment, refill your coffee cups, and we'll see you back at 11:50 a.m. Pacific. All right. Welcome back. Friendly reminder, we're going to open up for live Q&A at the end of this session, so keep those questions coming in the Q&A function at the bottom of your screen throughout the discussion. We hope the information provided by our experts so far is timely and valuable, and we look forward to staying in touch as your growth continues. If you're interested in booking a meeting with our partners, just please use the link in the chat. As you settle in, please participate in our last poll that will help us understand what you're trying to learn in our next panel. So, how many acquisitions from the buy side are you planning in the next few months? 0, 1 to 3, 3 to 5, 5 to 10. Let us know. And this will help our presenters and experts get ready for the discussion. All right, the numbers are coming in. Thank you all for participating. I'm going to end this poll and share those results. Well, it looks like 1 to 3 is our leader, but there's a pretty good mix across the board on the other ones. So thank you all for participating and sharing those responses with us. Without any further delay, please join me in giving a warm welcome to our special guests. Our moderator is Saran, the SVP of Corporate Development at Viacom CBS. We've got John, Managing Director at KPMG. We've got Melissa, Corporate Partner at Wilson Sonsini, and Yelena, Vice President of Transactional Insurance, M&A, and IPO Risk at Woodruff Sawyer. Team, welcome back. It's great to see all of you and to have all you back at this M&A Bootcamp. Excited to have you.
Thank you. Great to be here.
Happy to be here.
Great. All right. Well, Saran, over to you.
Excellent. Thank you very much, Colin. Wonderful to be back here in this virtual roundtable. My name is Saran Tanilian. I'm an SVP in Corporate Development at what is now Paramount Global, formerly known as Viacom CBS. Some late breaking news yesterday. I spend my time on all things M&A, investments, acquisitions, mergers across our portfolio of businesses in feature films, in linear networks and streaming. And with that, I'll turn over to John.
Yeah, thank you. My name is John Milner. I'm a managing director with KPMG's deal advisory practice, and I advise my clients throughout the life cycle of a transaction. A lot of that is focused around diligence and pre-closing activities, but also helping them guide their journey along the post-closing value creation stage. And I work with both private equity and strategic acquirers, primarily serving the technology space, which I've done for, gosh, too long now. But anyway, great to be here again.
I can go next. I'm Melissa Hollitz. I'm a corporate M&A partner at the firm of Wilson Sonsini. Echo John's, I've been doing this for a really long time. I realize I'm coming up on 25 years at Wilson this year. And I have a relatively broad practice, but the primary focus of my practice is representing serial acquirers and acquisitions.
And I'm Yelena Danayevsky. I'm Vice President of Transactional Insurance at Woodruff Sawyer, which is a top-tier insurance brokerage firm. I work with private and public companies to structure their insurance solutions, and I specialize in the M&A representations, warranties, solutions, and also the directors and officers insurance for IPOs with a special emphasis on SPACs and D-SPACs. Prior to joining Woodruff Sawyer, I practiced as a corporate M&A attorney for about 10 years, and I love doing that and love combining that knowledge with what I'm doing in the insurance world right now. And I also do a lot of writing and speaking in the area of M&A and D&O insurance. And I would invite you all to connect with me on LinkedIn if you'd like. I post a lot of my articles and speaking engagements there, and I'm happy to be here again and to see everyone back on the panel. Excellent. Well, welcome everyone. I'm excited to have this conversation. Last time when we met in October, I think we all agreed that it was a very busy time for everyone across the board. There was doubts around the ability to take some time away in the latter part of the year. So I'm excited to hear about how things have been going in the past few months from this panel. So with that, maybe I'll just open it up more broadly to everyone in the group and just pose a simple question. What's changed in M&A? What are you seeing out there in the past 3 months? I'll jump in. I've been seeing, December was crazy. I don't know if that's how everyone else felt, but I have not seen that level of activity. And I remember seeing articles about how that was sort of record highs for M&A activity almost of all time. And that was definitely reflected in the insurance space, where the underwriters were so overworked and so overwhelmed. Some of them even took time off, which is unheard of for a fourth quarter of the year. And as a result of all of that activity, the pricing on the insurance really jumped up significantly, and it was really difficult to get interest in deals. Since the beginning of the year, things have calmed down a little bit. So after the January cleared out all of the backlog, things are getting a much better right now, where we're seeing the pricing go down. We're seeing a lot more interest from the insurers to do the deals, some new entrants into the market, which are creating competition. So it's a much better situation for buyers who are interested in entering the market right now and using reps and warranties insurance to get into the market now.
Great. John, what are you seeing?
Yeah, I would say, 2021 was probably a banner year. It was a banner year in M&A, especially in technology. And that pace was continuing off of 2020, which was also a fantastic year from a volume perspective, and both deal volume and transaction volume. And I think what I actually saw, and my colleagues witnessed this as well, which is a slowing in December. And that wasn't necessarily a slowing in the market in terms of pulling back. I think it really was just a factor of deal fatigue with people, as we saw a lot of sellers that say, instead of launching a process in December, they're just going to hold off, launch it in January in the new year, and bring assets. I think a lot of advisors, be them accountants, attorneys, insurers, bankers, kind of got a holiday break from a lot of the folks that I talked to, which was much needed. Again, it's just kind of this fatigue happening. And then we typically see a compression in December, which is a bunch of people trying to get deals done by December 31st, be it a tax reason or something else. And we just didn't see a ton of that this year. There was some of it, but not as much as kind of was expected. And it actually kind of made for a little bit of a break. And then I think as we roll into this year, people are starting to get back active in the market. We're starting to see more processes kick off, but it seems like there's still a little bit of overhang from the last year in terms of the pace at which people are willing to do deals. Maybe not so much the number of deals, but the speed at which they'll happen will be a little bit slower, a little bit more reasonable.
Interesting. Melissa, do you have a similar sort of impression as you look at the past few months?
Yes, I do. I think, although I will say, I don't know that it felt like things slowed down. But I will say it did feel like there were fewer of the arbitrary, these must be done by December 31 transactions that we've all seen a million times in our career. I do think, I think John said it well, there was some element of, we have all been working at an insane pace for 2 years now, and there's some element of that everyone can only push themselves so hard for so long. So I think there was a little bit of rationality that came back in terms of deal timing. The underlying number of deals didn't feel like it was particularly abating. I feel like we still have a fair number of deals that are coming down the pipeline, so it doesn't feel like it went away, but there was a little more rationality that came in. Honestly, I do genuinely think, because people are just a little tired, and you can only do so much so fast.
That's fair. It was it's bound to happen. So when we spoke in October, I think we a good amount of the conversation centered on SPACs, given that they've played a fairly material part in M&A over the past year and two. I think we've seen, just from my perspective, I think we've seen some softening of SPAC IPOs, but you still have, call it 400-ish type SPACs that are listed or looking for M&A targets, and I think around half of those are would need to transact, kind of call it in the next year. So in that context, kind of what is the role you're seeing right now that SPACs are playing in the M&A market? Has that changed since last year in any way?
I think it changed. Sorry, go ahead.
No, go ahead, and I'll add.
So I think it's changed. SPACs are not the darlings they once were, and they are still going out, but they are not going out at quite the same velocity. So I think the obvious pairings, some of those have already found each other. And so what's left in the market, frankly, this is an overgeneralization, but you see some weirder deals. So some sponsors that it's not totally obvious why the target is attractive or why they're a match. And honestly, some of that is the nature of a SPAC. As you said, they have to transact, and they are built solely to transact. And so as we get to the end of that time frame, I can't imagine you won't still see them because they don't want to just give the money back and dissolve. So they want to do something. So I think they will very much continue to be a force. I will say they are more difficult deals to get done now than they were a year ago. And you see slightly wider ranges in terms of who's buying what for what terms.
Right. I would agree with that. They're more difficult. I would maybe categorize the weird a little bit differently. I'd say they're getting more creative. And Saran, you mentioned 400 of them needing to de-SPAC. As high as that number is, it's actually over 600 as of this morning. So all of these, right? I know it's incredible just to think of those numbers. 600 or 602 last I checked, with potentially 162 billion in trust assets to spend on acquisitions, and all of them need to go within the next year and a half or so. Similar to Melissa, obviously the market for SPACs has gotten very difficult. There's very minimal PIPE financing that's available that has practically dried up recently, which is a difficulty for SPACs. So there are some out there in the market who are saying that only a fraction of them will actually complete the deal and the rest will have to fold or liquidate, which is unfortunate and sad for some of these players. But that's just the nature of the beast, that the market got oversaturated too quickly. But I'm seeing a lot of interest still in the market for these deals. We're working on many de-SPACs at the firm with my team. We're seeing a lot of the target companies, the private companies looking to merge with the SPAC, still considering SPAC as part of their triple track, IPO, M&A exit, or a de-SPAC. That's still the conversation that's on the table. And, there's competition there from SPACs towards other types of entities that are trying to acquire targets, or PE firms or strategic buyers. There's competition there. I work a lot in this space. If anyone's interested, in October, actually, shortly after our last webinar, I launched a monthly blog series called the SPAC Notebook, which is available on the Woodruff Sawyer website. If anyone's interested to sign up, I welcome you to do that. And we're going to be talking about, we have been talking about SPAC activity and all the risks relating to SPACs, which is there's going to be a lot more of it in the future, unfortunately. A lot to talk about.
That's very interesting. I mean, since we're on the topic, I guess, Yelena and others, kind of what do you see as, what's going to make the ones of the 600 that are successful? What's gonna sort of that special sauce? Is it having some PIPE financing lined up? Is it, just the ability to get at the right target? Do you see any sort of pillars of success kind of as you look forward at this point?
Yeah, there's certainly a few elements that a bunch of these that are successful have in common. They have a seasoned team that has done this previously and knows how to get the deal done. A lot of them are PE based, which means that they have a lot of a big pipeline towards companies that they perhaps are more familiar with or have better into than other players out in the market. PIPE financing, for sure, is a huge thing, and ability to minimize redemptions, which have been a big issue lately. So all of those factors lead to a more successful outcome than otherwise.
Makes sense. So maybe if we want to talk a little bit about volume, and John, I know you made some reference to kind of the volume of activity in your introductory comments. Kind of curious what you're seeing now that you're kind of into the new year in January, February. Are you seeing sort of any impact to M&A activity as a result of some of the macro situations, things like the Russia, Ukraine situation and others, or is it kind of largely kind of the deal fatigue concept that was mentioned earlier?
I think what I'm seeing is more around the deal fatigue and things starting to come back. One of the interesting things about M&A is the timeline that it takes to kind of complete a sale process. And so when bankers are delaying processes until kind of the January, February timeframe, kind of coming back out of the holidays, like we won't see those transact until March or April at the earliest kind of timeframe. And as we're sitting here today and you've got some macroeconomic changes, you think about what's happened in January with the Nasdaq fall in terms of public equity valuations, some of the global political stuff, we just won't see the impact of that for a while. What I'll say is that it hasn't been changing the way that my clients are approaching diligence or the deals that they're looking at. I think they're all mindful of it, but I haven't heard a lot of clients trying to retrade deals because they kind of had an LOI or a term sheet in December, and then the Nasdaq took a nosedive in January, and they're coming back. They're still kind of holding to where they were. So I think we're going to see a pretty good 2022 in terms of M&A. I just think it's going to pace a little bit differently through the year. And what I'm seeing is just the process is taking a little bit longer and returning to a little bit more of a norm. I think Melissa mentioned it. We were running so quickly, so hard on everything for 2 years that something's going to give at some point. I think we're kind of coming back to that normalcy.
Yeah, is that a function of? It sounds like fatigue is certainly a big part of it. Is it also a function of just the reality of where buyers have realized there's only so many advisors with availability, and there's only when they go out to interact with legal counsel, advisors, etc. There's sort of the reality of being able to get a transaction done and what you can and can't do.
I think that's a very good point. I think that's absolutely correct. I mean, I saw a client recently where the seller expected a rep and warranty insurance, and the buyer just said, there's no way that we can get it done with capacity and the timeline that you're asking for, so let's find a different way to approach the indemnification around reps and warranties. So I definitely think that part of the advisor capacity is part of that.
Right, that makes sense. Well, I guess, speaking of, rep and warranty, Elon, I know you spoke a little bit about kind of that market, and we certainly talked about, in our last session, the demand increase for rep and warranty insurance and the ability of the insurers to sort of keep pace with that increased demand. What have you been seeing out there in terms of, volume of rep and warranty insurance policies and kind of how the insurers are reacting to kind of what they view as deals that they want to take on?
Yeah, so like John said, I don't want to see that situation ever again where someone says, I can't get a reps policy in place in time. Hopefully never again. But yes, we did see a few of these at the end of the year, unfortunately, because of the constraint in the market and just the flow of deals. But just to step back a little bit, for those who are not super familiar with the reps and warranties insurance, it's essentially a protection for against breaches of reps in the purchase agreement, and typically bought on the buy side, protecting against breaches of seller fraud and again seller's reps, and also against seller fraud. So it's a very useful product that has essentially become table stakes for any private M&A transaction, and some that are even bought by public companies. I actually was on a webinar recently and listening to a private equity exec who was telling an interesting story about how they got into using reps and warranties insurance, where they had gone out and lost 2 consecutive deals in a row because the other buyers had the reps policy or were willing to do a reps policy, and they didn't. And so he said that not using a reps and warranty policy is stupid. I'm using his words, not mine, but I kind of agree with the sentiment. But it's just become something that everyone uses and knows very well, and it runs smoothly. And has done so for a very long time, except for hiccup in December. But what I would say is the pricing that we were seeing in December that got really, really exorbitant is now coming down. So now we're down to, again, to about 3.5% to 4.5% of the limit being bought, which is a welcome trend. I'm sure John and Melissa will agree with that. We don't want to be seeing those numbers above 5 or above 6 or so on. So that's the trend that we're seeing right now. There's going to be more capacity in the market in the next few months, but because the year is going to be very active in general M&A activity, what I'm anticipating is that it will become a little more difficult going into Q3 and Q4 to get the deals that you want, because the insurers run out, sort of like they sell as much as they need to sell during the year, and they don't have enough more to sell later on. So for those of you who are considering using the product, definitely now is a good time. And also for smaller deals, we are seeing new entrants into the market who are looking at 5 million in limit and are looking to make that more streamlined, which is great news for everybody. There are some underwriting trends that I would like to point out to those of you who are looking to get into the diligence and really kind of dive into that space. The underwriters are now looking into more closely into things like customer contracts. Those have been an issue with COVID. And so that's an area of focus that everyone needs to pay attention to. Quality of earnings reports are a must. That has become the norm for, especially for deals that are unaudited and even some with audited financials. And cyber coverage is a sore issue. Many targets don't have enough or don't have any, and that becomes a major problem. So something to watch out for.
Interesting. And are there certain industries or types of assets where insurers are just not interested in providing revenue warranty insurance? Are there sort of no-goes in this space?
There are a few difficult markets. I would say like crypto is difficult. Cannabis is difficult. Some healthcare related deals are difficult, not across the board. And it really kind of depends on where you fall into, product or the service provider. So, a few things, robots with guns. Sure. True story. But we succeeded, I must say. That was successful. I don't know how we did it. But yeah, so there are a few, but the more interesting ones, the better. Bring it on.
Now I'm curious how we can stretch the envelope on that. Interesting. Well, good. So maybe just pivoting a little bit to the legal side of things and sort of transaction documentation and kind of the legal aspects of M&A execution. Melissa, sort of curious kind of what you're seeing out there. Has there been kind of a change in the way that buyers have approached the documenting transactions? Antitrust, is that coming back as a major issue?
Yeah, so I would say the underlying kind of risk allocation deal terms that we talk about all the time, I haven't seen any major changes on that front. Regulatory is absolutely an issue. I mean, it's at an all-time high. And so to the extent that those reflect in deal terms, so, the drop dead data, termination fee, effort standards, those you see heightened scrutiny or heightened attention on both sides of the table from that one. And I do think it has impacted, I mean, regulatory is frankly enough of a concern that you see, not all, but you see some subset of acquirers who know they're very much on the front lines and that everything they do, they can't buy an ice cream stand without that being scrutinized pretty heavily. And I think they're being careful about where they go in. And on the other side of the equation, I think you see some sellers thinking that antitrust risk is something that they should think about, which hasn't always been the case.
Right.
So I'd say sort of the macro level, general risk allocation, not so much, but on the regulatory issues, we are seeing some changes there and some heightened concerns appropriately.
Right. And what have you, I mean, do you have a sense of kind of what that's meant for timelines? Like, do you see more of a stretch timing in terms of drop that deadline, the dates as you said, and kind of how long it takes to get transactions to the finish line?
Yeah, I mean, I think there's a subset of the deals that were never competitive. They're still not competitive. That hasn't changed. The timeline hasn't changed. The deals that are that everyone kind of knows going in are going to be competitive. I mean, everything the last 2 years has taken longer, right? So I think the dates are going along with that trend, and I think those deals are also taking longer. And then there's sort of the middle ground of, gosh, we don't know what that's going to look like or not. And I think people are spending more time negotiating that uncertainty than they used to.
Right. No, that makes sense. Very interesting. And so just, I guess, maybe pivoting a little bit to valuations, and certainly, from our purview of a media company, what we've seen out there in 2021 has been fairly robust valuations, both from a public market standpoint and from a private transactional M&A standpoint. I guess, John, from your purview, and kind of what are you seeing in terms of valuations, both as you think about kind of at the end of last year and then coming into this year?
Yeah, I think you see a continued trend of elevating valuations across the board, at least in the tech sector that I tend to spend most of my time in. We haven't seen much of a reprieve off of the valuation, whether they be EBITDA, ARR, revenue type of multiples that are out there. I think it'll be really interesting to see what happens over the next, call it 6 months or so. I think we've got some macro factors that have the potential to either slow the pace of that growth or reduce it a little bit. What we're seeing in the public equities, as I kind of mentioned, we haven't seen, at least I haven't seen the impact of that coming through in the private market transactions yet. And I say yet because who knows what we'll see once those things start pricing and people kind of get a couple months out. And then we'll see what happens with the Fed. I mean, I think that's going to be an issue as we think about private equity with their traditional leverage playbook on what that cost impact happens with the implications of that are. I'm not sure that that's going to really pull back valuations, and we're going to see a huge decline in the M&A market in terms of that value. But I think it has a possibility to, again, mute it a little bit, maybe slow the growth a little bit, which I think a lot of buyers are wanting, frankly. I think, sellers are out there saying I can get as much money as possible, which is very true. And for kind of the proper functioning of a market, the buyers want to make sure that they're able to realize the value versus just being kind of backed into the corner that a lot of them feel like they are right now.
And do you see, I mean, we, from my perspective, we often sort of have this paradigm of, for growth companies, where you're getting awarded on a revenue basis, and then as the pendulum swings, you are in a land where there's a refocus on profitability, if not current profitability, sort of a viable near-term path to profitability. Have you seen that dynamic sort of play out in terms of, some buyers moving away from kind of awarding a pure revenue multiple without the profit side of the house being visible?
Yeah, it's a really great point. And I think you've started to see this pendulum swing over the last couple years, and it's definitely accelerated a little bit more, where a lot of buyers are looking not just at what is the top line growth of this, but the combination of kind of growth and profitability. So, you see, especially in kind of software, whether it's magic number or the rule of 40 or these other sort of metrics that are meant to measure unit economic profitability. I think you're seeing a lot more people report on those and think about those as they're valuing the business. So it's not just you've got a 10% gross margin or contribution product because it's a high cost to serve and you're getting a 10, 20x multiple on revenue. Like, that just isn't working, and it hasn't been working for a while. People are really focusing on both the growth and the profitability. More on the unit economic side, I find that most of the time the kind of SG&A corporate structure buyers realize they can change that. And especially the strategic acquirers are going to change it drastically. So it's more focused on the unit economic profitability.
Right. Sort of like lifetime value, or kind of the incremental profitability per customer. Gotcha.
Yeah. The focus on lifetime value and what your customer acquisition cost is and the ratio there. All of those are really great. A lot of people are focusing on those.
That makes a lot of sense. Maybe just going back to Elena, to the rep and warranty insurance discussion. I know you talked a bit about pricing, and it was interesting to hear kind of how premiums have shifted over time. I think you mentioned you're kind of back at the 3.5% to 4% of coverage in terms of premiums. Do you see that being kind of a stabilized level at this point, or do you see a lot more change sort of pending in that area?
Yeah, it's a great question. So like any market, the reps market is cyclical. When the price goes up the way that it did so drastically and so quickly towards the end of the year, the buyers, they were spooked. We heard a lot of grumbling from a lot of even serial acquirers who've been out in the market before and understood how valuable this product is, that they came back to us saying that, look, these prices are just not sustainable long term. Maybe we could do one deal with this right now, but we're really expecting to see much better pricing going forward. Some decided not to proceed with the deals and because of the pricing. And I think the underwriters got the message. They certainly got the message, because we are seeing much better pricing in the market last few weeks, for sure. I am now seeing, numbers in the threes, which we hadn't seen for a very long time. So that's reassuring. So yes, I mean, you're right. It would calibrate itself according to the demand out there. I think it is stabilizing. It is going in the direction of becoming more stabilized around that 3.5. I'm hoping 4.5 range, and we will see majority of the deals end up there. That would, I think, work well for everyone on both sides of the market. But of course, aside from the competition and deal volume, the other component to pricing is the claims activity, right? So in terms of what's been happening with claims, if anyone wants to take a look at this, there is a recent very good AIG claim study. They put out one periodically. They're seeing that the claims continue being basically the same as they have been in the past. There hasn't been a huge increase in severity of claims. The largest claims that are over 10 million, the average claim there was 19 million. So, I mean, those are big numbers that are being paid out, which is good. It's good for the market, right? Obviously, otherwise, if the claims are not getting paid, no one's going to buy the insurance. So it's good to know that these things are actually getting paid. The frequency hasn't increased so much. It's about 1 in every 5 policies that do get noticed for a claim. And again, there's another study from Liberty, which was great. They cited 35% of notifications end up with losses over retention, because each policy has that deductible retention amount. So, considering that the claims activity has basically been fairly steady, my prediction would be that the market is going to continue to stay where it currently is. I'm not anticipating increases in pricing, at least until maybe the fourth quarter.
Right. And presumably there's more comfort now as there has been a longer track record of kind of building that claims history. And so there's more data points to go off of, right? As time goes on, we have more.
And there's some insurers who have long histories of paying claims. And again, that's something that you want to talk to your broker about, get sort of the background on that, make sure you're working with the right partner.
Yeah, no, that makes sense. So then maybe just thinking a little bit about, I think private equity was mentioned in the conversation earlier. And obviously they tend to be a fairly material player as we think about kind of the pool of competitors for an M&A buy-side process. Kind of curious what you're seeing out there, and this is just more broadly to the group here, whoever wants to speak to it, but, kind of what you're seeing in terms of the approach that private equity is taking in the current market, relative to corporate buyers, relative to SPACs, et cetera.
Yeah, maybe I'll jump in first. I think private equity has played a tremendous role in, especially private market transactions, in particular in technology. And we've seen incredible growth in terms of their mix, and they're clearly here to stay. It's rare. I don't know, trying to think in the last year or so if I've seen a process where there isn't a mix of strategic and private equity. Now, they're all playing very different roles. You know, strategics can typically write a bigger check than private equity can to make the numbers work, but they run a lot slower. And one of the interesting things that I've gotten some feedback and heard from investment bankers lately is the pacing at which they're going to the market to appease both of those buyer groups. Typically, you have to go to your strategic corporates much earlier in the process. They've got more approvals. It takes them longer, where you know, your PE can go and do a deal in a couple of weeks, or at least get to a term sheet. They're saying that those timings are changing, or the timeline for each of those is taking a little bit longer, especially on the corporate side. So private equity is moving a lot faster, and you're seeing some pushback in the seller market to say, I want more corporates involved here because it provides a little bit more competitive pressure. I can maybe get more dollars out of them, but I've got to really adjust my process in order to get them engaged, get them interested, because man, a lot of those corporate acquirers will sit there and say, oh, you're already talking to private equity. Well, let's just move on to the next one because it's not worth this conversation.
Right. Oh, that's interesting.
Trying to change that.
So are you seeing some, from the advisor side, are you seeing situations where maybe they're adapting their process in a way where maybe they're previewing with strategics earlier in order to get some interest built up kind of as part of a broader process?
Absolutely. I'm seeing them go out to strategics even earlier than they used to. I mean, banks have always done this. They go out to the strategics first and then the private equity second. But the time window between those two, I think, got compressed over the last 2 years because so many deals were happening that, you know, if you were to give strategics 4 weeks ahead of PE, that pushed to 2 weeks, and that's now going back to 4 or 6 as just kind of examples for what we're kind of seeing out there. Because they do want a good mix of strategic acquirers in there because it creates that price competition with the PE market.
Yeah, no, that makes perfect sense. I'm mostly kind of query what you're seeing in terms of this timing concept. I mean, you know, versus, you know, for deals that are getting done quickly versus deals that are, you know, taking a bit longer to make their way through the process. Kind of, well, what differentiates that from your experience? Kind of which deals get done quickly and which do not?
Yeah, I think the deals that get done quickly are the deals that have to get done quickly. So if it's a competitive situation and somebody has to move quickly, you know, John said it well, people either get nudged to move more quickly or say, I can't play and get out of the way. And so private equity is always kind of an interesting player because they will push to a more disciplined process and than corporate can sometimes do or will do on their own. You know, again, I do think a lot of it circles back just to bandwidth. So the deals that were really high priority, that really had to get done, that, you know, where you'd go to the advisor and say, look, I understand you're busy. I really need this by X date because public announcement, because of a fear of tax changes, whatever it is. I think people would still try to run hard to get to those deadlines. But the number of like, I want to do it by the end of the month because I'm going on vacation, we also sometimes hear, like, those deals are on the whole maybe getting back to a place of a slightly more rational frame, just because we could not possibly as advisors have matched every time frame that people had wanted us to in the last couple of years. It just wasn't possible.
I'm glad to hear there's some sort of you know, move back to kind of a sense of, you know, reality and practicality. It's good to hear. So I guess, look, I mean, obviously a big part of the process here is due diligence. And, you know, I think there's always a sense that when it's a very seller-friendly market, you know, our buyers sort of pressured into shortcutting their due diligence efforts in order to be competitive. Maybe I'll turn it over to you, Elena. Kind of what have you been seeing out there in terms of due diligence, best practices, and kind of how buyers approach the due diligence process?
Well, right. This perhaps is the more interesting part of the entire deal, right? The diving into the diligence and seeing what's under the hood and seeing how the buyers conduct the diligence. Maybe going back to what John and Melissa were saying on private equity versus strategics, they have their own styles. PE firms usually have a very structured diligence process. They know exactly what they're doing. They've got it all set out. They've got like dates and timelines, and they usually stick to them. Strategics sometimes take quickly, sometimes take months or even longer. Right, unfortunately. But on the flip side, the strategics actually usually know a lot more about the business because they're in the business, so they know the customers, they know the area, they know the suppliers.
They know what to ask.
They know what to ask, right? Exactly. But also sometimes they get a little too sure of themselves, and this is where they run into problems, because what ends up happening is, with cutting corners, like you said, some of the strategics think that because they might have the same customers or overlapping customer groups with the target that they're purchasing or supplier channels, they don't really, they tend to rely a lot on the sellers, whatever the seller says. The seller says, fine, we're all good with the customers, we're all good with the suppliers. And perhaps not do as much of a deep dive into that area as they sometimes need to. And the underwriters have been, the reps and warranties underwriters have really been pushing back on that because there's been an increased level of activity and claims in this particular area. So insufficient review of customer contracts, looking at 2 out of 3,000 is not really going to do it. And you can't really come back and say, well, I know all those customers, they should be fine. They're not going to walk when we sign the deal. That perhaps is not, that could turn out not so well. So I would encourage folks to really kind of look into that a little bit more. Customer contracts has been a main issue lately. They're the 4th largest number of breaches. 12% of all breaches are in that area, according to latest studies. Financial statements are the first. They've always been the first. Taxes second, compliance with laws, and then now customer contracts. So something to really consider. And what would be great to do when you're looking into the diligence, do those customer calls, get on the calls with customers, make sure you discuss, the deal with them, make sure you understand what their thoughts are on what they are planning to do post-deal, look into the internal controls around contract administration, that's also key, and sort of understand how the expenses are going to feed into the financial statements. So those are the areas that we've been really seeing a lot of attention from the underwriters.
When you speak to customer contracts, is it kind of a question of the strength of those underlying contracts and ability of customers to get out of a contract post-close that's been one of the issues you've seen?
That's right. The ability to get out of the contract, not being happy with the change of control, having any sort of excuse to get out of the contract, simply just not liking the buyer, maybe not thinking of them as warmly as they had of the target team. And
it's a real issue with strategic buyers. You don't know the reception you're going to get sometimes.
Right.
Interesting. So, Melissa, maybe I'll turn it over to you just on a related note. I mean, I think you spoke a little bit about this earlier, so I suspect I may know the answer, but kind of as there's been maybe, kind of this shift in terms of, buyer, seller market, and the role of the buyers in the sellers market. Has there been any sort of changes in terms of the deal terms? I mean, it seems like there's been sort of fairly limited changes to those, but is there sort of, you're seeing any shifts in kind of where the power sits, across the negotiating table?
Yeah, honestly, what makes my job interesting is just every deal is different, right? So I would say I haven't seen any macro trends in terms of, risk allocation has fundamentally changed. But depending on who the buyer is, why they're buying, why the target is selling, how much the target wants to sell. Do they have VCs or do they just have a founder who wants to go lie on a beach? Like all of those impact deal terms, like they really do.
Yeah.
And so the terms for each transaction really are bespoke based on the different motivations of both sides, and based on what type of transaction it is.
Yeah. No, that makes sense. That makes sense. Just being a bit conscious of time and making sure that we have enough time for Q&A. Maybe we can sort of finish up our discussion, doing kind of a roundtable, if you will, and hearing from each of you, one, kind of where you see the market, the M&A market going this year, and two, just kind of your summary takeaways for the buyers out there that are listening to this discussion. And maybe I'll start with you, Melissa.
Sure. My predictions are always terrible, so listen to what I'm about to say. We still have plenty of deals coming in. It doesn't feel like things are going to fall off a cliff anytime soon. It does feel like things have settled down a little bit from prior levels. So I'm going to predict it's still going to be strong, but not quite at the insane levels that we've been seeing. And then in terms of the takeaway, I think I would just double down on what I said a few minutes ago, which is, it is really important to understand the market and understand macro trends. It's also important to understand that each transaction is going to be different, and to really be thoughtful about, what actually matters to the transaction and why, and to sort of correct for that instead of what you think the outline should look like.
Right. That makes sense. John?
Yeah, I'm going to agree with Melissa. I think that we are not going to keep going on the pace that we were just on for the last 2 years. I think it's, hopefully going to come down a little bit. I still think it's going to be a robust year from a dollar and a count perspective in terms of the M&A transactions that are out there. I just think there's going to be a little bit more rigor and maybe not as many. And so I think we're going to see a little bit of decline there, but not much. I mean, we're still at peak numbers here. And just in terms of a takeaway, again, Melissa, I think said it great in terms of what's unique about this transaction. The piece that I would add to it is, most strategic acquirers are going through and saying, what is my build versus buy decision? That's why they're in this conversation, and really being clear on those fundamentals, because even if things are not as fast-paced as they were for the last 18 months, and we're dialing it down just a little bit, it's still very expensive. It's still very complex, difficult to do a deal. So you want to make sure it's the right deal that you're doing, and you're fundamentally aligned on that make or buy decision for your deal thesis there. I think that is really critical, because people do a deal because they see other people doing deals and think, I need to be doing deals too. But reality is you don't, and you have that kind of build path forward.
No, absolutely. Thank you for that, John. And Yelena?
I'm going to echo what John and Melissa are saying. The M&A market's looking good. It's looking good right now. At least for the next couple of quarters, I'm not anticipating a slowdown. Definitely a good time to join in if you'd like to. And in terms of a takeaway, I am thinking the diligence would be a good place to look, even if you're not doing a reps and warranties policy, just for your own peace of mind and minimization of any kind of risk. Pay attention to it, make sure you do a deep dive, and that will serve you well in the long run.
Thank you. All very good advice. It's been informative for me to hear sort of your updated perspectives here, and kind of get a flavor of what's been going on out there beyond sort of the perspective I have here in my role. Thank you for that. So I think we now can take do a bit of Q&A. And for the audience members, please do go ahead and use the Q&A function to add on your questions. I know we have a few that are waiting in queue. And we also have a few that have come in prior to this session, which we can tackle now. Maybe starting with one that had come in before our Q&A session today. There was a question that was posed, a very good one, around adjustments that are made to the valuation at closing. So things like working capital adjustment, et cetera, which are usually a part of an M&A document. The question was around whether you're seeing more of kind of the lockbox mechanism that's been more popular kind of outside the US being used more often here in deals in the US. I don't know if you have a perspective, Melissa or John or Yelena.
Sure. Yeah. So I guess the first thing I will say is this has always been a thing that people did. I mean, in a small transaction, often it just doesn't matter what's on the balance sheet. You don't have to really change anything too much. So we have always seen deals done on this basis at sort of the smaller levels, or for strategics who frankly just didn't care so much about the smaller dollars and cents around the margins. But again, I do think as people, those provisions take an inordinate amount of time to negotiate a lot.
Yes, they do.
With frankly not a ton of payout. So I do think there was a time when everyone you just needed a working capital adjustment, like you just did, and you couldn't do a deal without it. I do think people are being a little bit more rational about, sometimes they absolutely make sense and sometimes they don't make any sense at all. And so I think people are being a little bit more thoughtful about using them when they make sense, which I think is great.
Yeah, no, absolutely.
Yeah, I mean, I think I see the completion accounts, your working capital adjustments, your indebtedness adjustments on most deals. I think what has changed is the level of negotiation that goes into those. And I guess I would attribute it a little bit more to being a seller's market, that sellers are saying, how do I minimize this adjustment? The old playbook 5-10 years ago was PE come in, negotiate something and come back and extract a lot of value in that post-closing adjustment. And now sellers are saying, how do I start limiting that? And one of the ways that you mentioned is lockboxes, very traditional in Europe, rarely seen here in the US, but the number of conversations that Lockbox has come up with in the last 2 or 3 years, more than the 10 years before that. So people are starting to talk about it, but I rarely actually see it done.
Yeah, interesting. There are certain benefits to it. So I do have. I mean, I think your comments resonate with me, because certainly there's a sense of that for the award or the benefit of the adjustment you're getting, the amount of time spent negotiating does feel disproportionate a lot of times. So very interesting. So along those lines, you spoke about sort of smaller deals, smaller companies. Maybe focusing on companies that are earlier stage, maybe pre-revenue and EBITDA, tech companies. How do you, John, maybe you may have a view on this one. How do you think about, positioning valuation of a tech company based on the asset, the technology they've built and the value they bring to a corporate buyer versus, valuing that company on a kind of a revenue or EBITDA multiple type basis?
Yeah, I think it absolutely gets back to that buyer build decision that acquirers are going through. I mean, I've seen a handful of transactions over the last year that I've worked on that were entirely R&D organizations. There was no commercialized product. There was no revenue. There was nothing to base it on. It was just an engineering team developing something. And what the acquirer wants is an assembled workforce. They want to go pick up 50, 200, 400 engineers that know a specific aspect. And so they're making that buyer build decision to say, I'm going to go buy that rather than try to go hire those people on my own. And from a valuation perspective, that's really where it becomes, what is the competitive tension in the market? I mean, you've seen some transactions in some of these companies with some of the large technology acquirers that are paying what I think are somewhat astronomical sums for just a workforce. But that's because they're sitting down saying, if it's not me, it's one of these other Fortune 50s that are coming up with the same price. And so how you got there is a little bit arbitrary, other than these companies are saying those prices are cheaper than me trying to go hire those people in terms of my speed to market.
And I was saying the time it takes to build out that workforce and sort of the foregone potential. I mean, at some point, when you're competing in a certain competitive market, that starts to become quite material. So
so there's no magic number to say, how do I put a price on it? It's just who else wants, the IP or the workforce that you've assembled there, and how do you create that competitive tension to drive price?
Yeah, got it. Thank you for that. Elaine, I think this one you may have a view on. One of our audience members asked, what would be a typical range of SIR on the rep policy?
Right. So the SIR they're referring to is the self-insured retention, which is sort of like a deductible. Each policy has one. It's been market standard to have 1% retention across the board for 1% of enterprise value or purchase price. That's been standard for larger deals that could go down to maybe 0.75%, or for over $1 billion deals, maybe a little bit lower. But it's been basically 1% for the rest of the market.
Thank you for that. I'm not seeing anything else pop up on the Q&A screen quite yet, so maybe we'll go back to one of our pre-session questions. We did have one audience member ask about, Cayman Island structures in U.S. M&A transactions. Anything you're seeing out there on that topic?
I don't know that I've seen anything particularly different. Generally, it tends to be a tax-driven structure, and so to the extent that you're dealing with a U.S. acquirer, they're going to make sure they understand the tax impacts. I don't think you're going to see particularly different transaction terms or a different transaction process. I don't know.
Maybe just generally on, not specifically Cayman Islands, but US versus non-US, there is a difference. For some of the insurers, US insurers are not able to write policies for non-US insured. There are some ways to get around that by having an affiliate be the insured on the policy versus the buyer that is non-US in the purchase agreement. But that could run into problems sometimes with some of the insurers and could limit the market of carriers that are interested in writing the deal. And the other thing to watch out for in terms of international operations and footprint, the more difficult or involved they are, the least likely you'll get a lot of interest in the deal, and the pricing might reflect that as well.
Got it. That makes sense. Well, good. It's been such a pleasure. Thank you for carving out this time and oh, actually look at that, we have one more question. I think we have just enough time to round out our session. The question is, how is a realistic first indicative offer made? When interested in buying a company, it's sometimes not possible in a few days for the company to invest the time. What sort of a fast approach in making a first offer?
So if this is from the perspective of a buyer, I think you've got to think about it in terms of, are you preemptively going out to a business that you like to say, I'm interested in acquiring you? And in those cases, what I've typically seen done is it's really a senior level conversation. People know each other in the market. It's a CEO to CEO sit down and have a dinner or another conversation around something around what is the art of possible going forward. I see those processes happen less frequently. There's a whole process that a lot of private equity has around trying to find VCs do this too, around calling and trying to develop those relationships with those management teams so that they're a known quantity when that company decides to raise capital or sell itself or do something. But most typically, they're being run as a process by an investment bank. And so the investment bank is giving advice in terms of, here's what we need from you. Here's what you need to come to the table with. Here's the process that you're going to walk through. And they lay it out. So it's about making sure you've got those relationships with the bank. So you're seeing the deal flow coming in. But they're going to be the ones that help you through that process, or maybe not help you, but at least tell you what they need.
Right. With some lead time, presumably, in most cases.
Yeah, with some lead time. I mean, typically I'm seeing that, the teasers will go out. So the initial indications, et cetera, when auction processes are starting, it may be weeks or months before they're asking for term sheets and trying to get to an LOI. So people have time to react and figure out if they're interested in an asset that's going through a competitive process.
Yeah, that makes sense. Well, very good. Thank you again. very much enjoyed listening to to sort of this being part of this conversation and hearing all this input. Maybe with that, I'll turn it back over to Colin.
All right, thank you, Saran, Yelena, Melissa, and John. You all are our buy-side all-stars. So thank you so much for coming back this round and sharing updates from your end. Really appreciate you all contributing your time, wisdom, and expertise. Thank you so much. And everyone on the call, thank you all for joining us today. We hope this was helpful, insightful to understand the M&A process from both sides of the table. We'd love your feedback. So if you're interested in learning more, booking a meeting with one of our partners, I'm just going to launch a quick poll to round us out with the end of the day. Also, we are dropping a survey into the link into the chat. If you want to give us some feedback there as well, we'd appreciate it. But on behalf of everyone at the Nasdaq Entrepreneurial Center and our partners, thank you so much for joining us, and we look forward to welcoming you all online soon. Thanks again.